Chapter 9 is going to focus on shorting lower highs on stocks that are spiking, one of the methods I have used to try to time the top of a spike. The basic idea behind this strategy is that even the stocks that are big runners, they don't just go straight up. There's usually a lot of choppiness along the way in a period where the stock has to pull back and consolidate before it can set up for the next leg higher. My goal is to get short into that big upward move and then cover into that pullback and consolidation while the stock is deciding which way it wants to go. I want to take advantage of that predictable pull, and then I want to cover up and I want to move on to the next setup. This is definitely one of the more risky strategies, especially if you're bad about cutting losses. It's very easy when you see a stock running to say that the move is too much or that the stock can't go higher, and those are assumptions you just cannot make with these, because most of the time you will be right, but on those rare exceptions where you're wrong, you get yourself into some serious trouble. Also, since the stock is still green when I'm shorting it, since it is still into strength, still into a spike, I have to be careful to make sure I take some size off into pullbacks. I need to pay myself along the way. If I get over patient, it's very easy to let a winner turn into a loser. I'm not shorting into these spikes thinking that I'm shorting dead top of the move and the stock won't go any higher. It's just looking for that quick short-term pullback. The main stocks that I'm shorting with this strategy are the ones that are on my top percent gainers scan. The ones that I feel already have run quite a bit and might be ready for that pull. Timing that is not easy, and a lot of times you're going to get faked out along the way. Basically, I try to let the stock run. I try to let it spike, run out of momentum, and then have its first hard pullback. And once we get that first hard pullback, that's when I start watching especially carefully. Then I want the stock to bounce back towards the highs. I want it to put in a lower high ideally, or maybe even double top. But my goal is to get short into that bounce back up after the hard pull and risk off of the high of the day. That way, in a lot of cases, you at least get a pullback, retesting that previous low, but a lot of other times, you will get further crack, further fade, and have a chance to cover up for even more in profits. In order for me to trade one of these, it does have to be well above average volume. I need it to be a nice liquid stock. And I also want it to be a large run from its previous support and consolidation area. Large, it is a relative term. I know a lot of people want there to be a set number percentage for that, where I say, oh, if the stock is up 25% or if it's up 50%, I start looking to short. No, I don't really think like that. I'm looking at the daily chart. I'm looking at how much this is running relative to its typical action. Attacking these on day one of the move is the most risky, so I usually do prefer it to be day 2 or beyond. I want it to be a second up day or a third up day, maybe even a fourth up day, because the further and further along we get into the run every passing day, the pullbacks should become more and more severe and more likely to lead to total collapse. I'm going to walk you through a few examples here using VLTC as my guide. VLTC is a stock that, as I'm recording this, it recently has been running quite a bit. So we're just going to go through a few examples of how I would apply this strategy to VLTC on its way up, and give you an idea of some of the winning trades and losing trades that I might take. The first chart you see here on VLTC should look fairly familiar because this is actually some of the action you saw earlier in the DVD when I was playing its breakout. It had this first big spike from the 425 area up to $5, and then it did pull pretty hard back down to 475. But that's not a move that I would consider for a short because it did just break out past the 475 area. So I don't think it's extended enough yet. I'm thinking about how much is it up past that breakout area. And 25 cents a share, which is less than 10% in this case, that's just not that much. But as it continues up, the first really hard crack, really hard pull we see out of it is up near this $6 area. And you get a nice hard pullback from about $5.80 or $5.90 all the way back down to $5.50. After that crack, we start to get this bounce. And this bounce is an example of something I would look to short into with that $5.90 high of day risk. As we move on to this next chart, you can see that we did get some further fade after that peak up. It perked out at about $5.80 it looks like on the lower high, and then faded right back to that $5.50 area, and after some consolidation even cracked under $5.50 briefly. This is an example of an idea that would have worked out okay, and I would have been covering into this move. Maybe I would have saved a small piece for a bigger move, but I would be paying myself along the way into the fade. But if I had stayed over patient, if I hadn't paid myself, if I had tried to hold out for total collapse back down to $5 or under, I would have put myself in a world of hurt because this did squeeze back, this did reach new highs. and later as it broke past this 590 area, I would have been forced to cut the loss. The very next morning on VLTC is another example. We had this big gap up in morning spike from a low of about 625 all the way above 7. It topped out at about 710 that morning. And then we had a quick 50 cent a share pullback back down to 660. After that pull, here we go again, another bounce. And that bounce is something that I might think about shorting into. I would short into that lower high, 680, maybe 690, something like that, and I'd be risking off that high of day at 710. There was a quick couple of minute pull back into the mid 660s right after that, but then it blew right back up to the highs of the day and broke through 710, and I would have been forced to cut that loss. So in this example, it would not have worked. That doesn't necessarily mean the play is over though, and that doesn't deter me from trying again. I'm going to let the stock go higher, and next time it sets up, I'll just try again. And the next time it sets up, it has topped out up in about the 740 area and then had a hard crack right back under $7. So into the first good perk after that crack, up to this 725 area. I'm trying again. I'd be shorting there. In fact, I did short there. I got short at about a 723 average if I remember correctly, and I was risking it off of the 738 area. In this case for VLTC, this was the day of the big pullback, day 2 after the breakout. It pulled all the way back down into the 580s. So well over $1 a share from where I entered. Unfortunately, I wasn't able to stay very patient with this. I covered in pieces along the way down. I think the best pieces I got covered were in the 660s, so I left a lot on the table here. And that usually is what winds up happening for me with this strategy, is I'm just taking the quick, predictable pulls, I'm not swinging for the fences, and I'm not giving the stock a chance to ramp back on me. I don't turn it into a guessing game of whether the stock is going to totally collapse or not. I just pay myself along the way, and then I move on to the next setup. Let's move on now, showing a couple live trade examples of me putting this strategy into action. The first example of this strategy I want to take a look at is ARNA. Right now, ARNA, it's having a huge run. It's traded awesome volume today compared to any days previous. And really, it's getting to the point where I feel like it's a bit overextended. It's up quite a bit on the day already. You look at the daily chart and you can maybe see some resistance here in the 480 area. But since there wasn't a whole lot of volume on that day, nothing even close to above average, it's not something I'm weighing in too heavily into my decision making here. The reason ARNA has my attention right now is because this really is the most extreme pullback it's had all day. So now that it's having this hard fade, I'm thinking maybe a top is in. And I want to watch rebounds, and I want to shorten to a rebound with my risk off of that 484 high of day. I really am looking at this more on just an intraday basis at this point. I'm trying to look at this chart and pick up whatever key levels I can from it. And the other thing I notice is that we have had a few dips here earlier on the run up that all held above the 450 area. So it's possible that if I short into this perk, the next dip does hold this 450 area again. There's still potential for profit there, but ideally we put in a lower high or a double top and then fade off and snap below 450 and start to have a really nice fade down. And I will be paying myself along the way into that. So right now, as ARNA is perking through 470, I'm starting to think about putting on my starter position. I don't want to short it too close to the area it just based at, so a little bit closer to 484 and I'm interested. I decide right there mid 470s is good enough for me. I take a 10,000 share starter at 475. I'm risking 9 cents a share on this. The closer we get to that 484 area, the more I'll want to add. I don't think that first perk back we're just going to blow through 484 here after that hard 20 cent a share fade just a couple minutes ago. So far, mid 470s have held pretty well. It's looking like that might have been a lower high. I'm just trying to wait this out right now and give it a chance to develop. Since it does seem like it's a little bit heavy to me, a little bit weak, I put in another 10,000 share order at 473 on the offer. I filled most of it already. I'm up to 18,850 shares from a 474 average now. And right there, we start to crack back under 470. So it's looking good for my short right now. But we are fading back into this support area where the last dip supported and where previous dips supported just above 450. So this is kind of the moment of truth for my short. I need to start seeing some real signs of weakness and some breakdown to make me think this is going to roll over further. I have a dime risk on my short now, but if this does start to crack and break down, I think that there's a chance for me to make 20 to 30 cents a share. Mid 460s are testing right now. The longer this holds, the more nervous I get. This is the toughest part about shorting into these moves, because this is still a very green chart on the day. This is still intact. So I don't know if this is simply consolidating for the next leg up, or if it's about to have further breakdown. But I've already got a little bit of cushion on my position, and my risk is very under control. We're getting another test in the mid 460s area right now. We briefly were under 465 there. We had some 464 prints. Back under again. So yeah, now we're into the low 460s. And I'm up about a dime a share on my short. So just a little more support to crack, and then this really should start going in my favor. Sometimes if my size really is out of control, this is where I start paying myself a little bit. Just locking in a little bit for 10 cents a share while I have the gains. But with 18,000 shares from 474 and knowing that I'm only risking a dime, I feel pretty comfortable right now. I want to try to be a little more patient and get a little bit bigger of a move. So far, low 460 supported. We're actually bouncing up a tiny bit right here. But no meaningful perk up quite yet. We're still under high of day at 484, and we're still under that 475 area where that last lower high peaked out. We do start to perk a little bit back through 470 right now, though. But choppiness, that's not unexpected for me. If I start to see some kind of a trend reversal, like maybe it gets over that 475 area, then I might start to get a little bit more concerned and start thinking about an exit strategy. Right here, we are retesting that last lower high. For now, though, it's held a second time. ARNA is going to try to knock back under 470 here. I decided to start taking out a piece right here at 468. I'm looking for some covers because I just don't like how long this is taking. I'm losing patience. So I want to get out a little bit into a dip and downsize. I didn't like that last retest of the 475 area. I actually decided to put it in my entire cover order at 470. I couldn't fill at 468, and even at 470 I only filled 2,000 shares. And now ARNA, it's perking up again, and I need to hope that there's a pull back down to 470 to fill me the rest of my order so I can get out for some profits here. I just am not happy with the way this has held up so far. The 450 supported, the 460 supported. This is starting to look like it could curl up and spike on me. It is a bit impatient of a cover since my risk level hasn't been hit yet, but I'm thinking conservatively right now and I don't want it to even come to that. Right now we're just battling in the mid 470s. I'm not going to chase it up here and stop out into the strength at this 475 area. I'm only stopping out into strength if high of day breaks. Right here though, we perk through 480. We start running back towards that high of the day. 484 breaks and now we're at new highs. And I have to throw in a cover order at 485 for the rest of it and I get filled. And I just took a $1,700 loss on that position. So ARNA here, at best, I had a chance to take maybe 10 cents a share, but I didn't take it. I wound up having to cover into the strength on the high day break, and I'm left with a loser. End of day, you can see it's a good thing I did take that loss though, because it kept going. I got up to 610, and along the way, when it went to 610, it really never offered any kind of a good pullback again after consolidating for a little while in the high fours. So if I had gotten stubborn, if I let this rip through 5 on me, my best case scenario is probably a cover into that dip down to about 520. So I saved myself bigger losses by cutting, but it was unfortunate that I was trying so early there. At the time, it looked like a great opportunity. It looked like it might be topping, but I was wrong. It held together very well, and I was forced to take the loss. Sometimes that's just how it plays out, and there's nothing you can do but stay disciplined. Next up, let's take a look at NDRM. NDRM is up a ton on the day already about 100%. So far I've had success trading it. I'm up about $10,000 on it so far, so I've had a great morning with it. But as NDRM keeps spiking, I think that this is getting more and more ridiculous. I see a stock that is up huge on volume unlike anything that's ever traded before, and I'm thinking, when is it gonna pull back? When is it time to short? This most recent run is pretty much straight up from 1150 to this 1260 area. So I'm waiting to see some sign of cracking action, some sign of weakness. After we have that hard crack, after we have that weakness, then I will short a pop and I will risk off of whatever the current high of day is. Right now as I watch NDRM, I am seeing a pretty hard pull off of that 1264 area. That last pull got down into the 1220s. So this could be that pull right here that I've been waiting for. Right there, we just had another knockback into the low 1230s, high 1220s. So my problems start right here with that entry. I put on 5,000 shares at 1235. That wasn't much of a pop off of the lows. Now we're getting the perk that I should have waited for back into the 1250s. So right there, I did add some more. I got my average up to 1240 and I have 10,000 shares. I want to risk this off at 1264, the high a day. But wait, right there, already it blows right through 1264. And now is my second problem, because I decide to hold on. I get stubborn. All of a sudden, we're up in the 1280s. I know I've mistimed this. I know that that was not at all what I wanted to see happen. I wanted to see lower highs and for it to roll over. I didn't want to see it blow right through high a day. But I didn't really wait for a hard enough pullback, and I set myself up for this to happen. Now instead of just eating my loss, I'm hoping that I get some kind of a pullback towards break even. And who knows what my motivations are here. I can't remember the exact specifics, but it's very possible that I'm looking at my $10,000 in realized profits, and I don't want to eat this loss because it'll knock it down from 5 figures to 4 figures. You may think that sounds really silly. You may think that could never happen to you, but you'd be surprised the dumb things you can do when your emotions come into play in the middle of a trade. So now NDRM is just continuing to squeeze up on me. We just ripped right through $13. And mistake number 3 is, as I continue holding on to this, I'm thinking to myself, it's already up way too much. It's up 114% today. This is ridiculous. It can't possibly keep going. At some point, it's going to have a great pullback, and I'll just take off into that. I don't want to cover into the spike. I don't want to chase strength. I just feel like it'd be very foolish to do that. Basically, I justify my stubborn hold. I assume the stock can't go higher, and that is a very, very dangerous assumption to make. Because even if it only happens 1 out of 100 times, if you get stubborn enough, if you add enough, that 1 out of 100 is all it takes to blow you up. But right now, I am just stuck holding my 10,000 shares. And unrealized, I'm already unrealized $9,000 at $13.30. So I've basically given back my whole day already if I have to cut it right here. And that is also definitely going through my head right now. I don't want to wipe out my morning. And then some. Now we're at $13.50. I'm also thinking that this spike is speeding up, and I just keep waiting for it to top out. I keep waiting for that pullback to happen. I just want the spike to top. I just want to get out into the pull. That's it. That's all I'm asking for right now. But the stock is not giving it to me. And I'm in a very unfortunate situation right now. I am now down $1.50 a share. And this all happened in about the last 20 or 30 minutes. And NDRM just perked through 14. Now after that 14 perk, we're getting a little bit of pullback. And you might see that, hey, that just perked at 14.12, slammed right back to 13.60. Maybe this is the lower high we want to add into. Maybe this is the lower high I should be shorting with that 14.12 risk. But because I have that horrible stubborn bag hold, I'm in no position to do that. I'm very, very flustered right now in this trade. Right now, I'm basically just sitting and waiting and hoping that this turns into a really severe pullback so I can somehow get out okay. We do start to see more weakness, and here we go. We dip into the low 13s. But even this dip right now, it helps, but because of the situation I put myself in, I'm still down $1 a share. If I had cut this at high a day like I had planned, like my strategy says I should do, I lose 20 cents a share. Right now, I'll be lucky if I can get out for less than $1 a share of loss. NDRM really is the perfect example of why we have rules. Because yes, in a lot of cases, you can get away with breaking rules. But then this one comes around and absolutely crushes you. So after a little perk there back into the high 13s, NDRM is fading back off. Back to the low 13s now, and hopefully setting up for some more fade for me so I can get out okay. And that 1340 area snaps. So we're right back into the low 13s now. And we just have a little ways to go until I might be somewhere near break even. And unfortunately, that is the other element that comes into play now. It's very hard not to think, oh, I'll just hold for break even. And you get that dip that's trying to let you out, but you don't take it because you just hope it goes a little further. Talk yourself into holding for just a couple more minutes because you don't want to take a loss right here when if you'd been 5 minutes more patient, maybe you could have been out for break even. Stubbornness really opens the door to all kinds of other emotional battles and all kinds of other mistakes. Right here, I put on an ad on NDRM. I'm adding into this perk up to 1350. I'm hoping for yet another lower high. I added 5,100 shares, so now I'm 15,100 shares from 1277. I tried to get my average up because I think that if we snap under 13, maybe I can get out for about break even then. So far, NDRM isn't really giving me that dip that I want though, back into that 1310 or 1320 area where it bottomed out last time. Right now it starts to retest. But so far holding strong. Just dipped under 1320. I could be covering into this dip right now and still be green on the day. But I want to hold. I want to wait. I still just want that break even. I'm not thinking about the fact that this is already down $1 a share from its highs. I'm thinking about where it is compared to what I'm in from. And now, unfortunately, we perk through 1350. And it starts to look like NDRM might be changing trend. And suddenly we're back into the 1370s. I added once again into that perk. I'm up to 20,000 shares from $12.99 now. I'm just kind of mindlessly fighting this stock, and I have to risk this all at this point off a high a day. I will allow myself to add sometimes when a position is going against me, but I have to cut if it breaks high a day here. Because I can't let my size get out of control and have it continue to squeeze and continue to run. It did just perk through 14, but it did not get through high a day. So we came really close to me stopping out right there. And now we get another hard slam back down from about 1410 down to 1370. And I'm holding my breath and saying a prayer and hoping that this just weakens again and starts to go my way. But I had to panic out there. It started to perk through 14 again. I could tell it was going to blow through high a day. So I ate the whole loss and I took a $20,000 loss there. I went from up 10,000 on the day to down 10,000. Had I just respected my risk, even if I had gotten out a few cents above, I only lose $3,000 there. But instead, I let this balloon on me. I got emotional. I got stubborn. I made a lot of mistakes and I paid the price for them. Even though I just took that big loss on NDRM, I'm down, but I'm not out. I'm still watching this because I think that there still will be a good pullback at some point today. I want to try again. I'm just going to let it run further, and then I'm going to reset, I'm going to start fresh, and I'm going to try to do what I should have done the first time. So right now, we're back to square one. We're looking for the first hard pullback off of a spike. Once we get that hard pull, I will be watching a rebound. I will think about shorting into that. And again, I'll have my set risk, whatever the current high day is. And hopefully next time I respect it. NDRM appears to be struggling right now in the 1480 area a little bit, but hasn't had any kind of a hard crack yet. That 1450 area seemed to be supporting, but right there it just snapped under. So now this is kind of a hard pullback. We're down 60 cents a share all of a sudden from high of day. So here comes my redo. Into this pop, I can try short again. I can risk it off that 1480 area, and hopefully I can get several legs down to cover up into along the way. Make back some of those losses. Start getting a bit of a perk here. And I did put in a short order at 1444. I was on the offer hiding my size. I filled it all. So I'm risking 35 cents a share about. Unfortunately, it appears that I mistimed that a little bit. This is a pretty strong perk back. And it just blew right through 1480. Here we go again. I'm holding my short once again here. Despite just taking that $20,000 hit because I got stubborn and wouldn't cut my losses, I'm starting to do it all over again. NDRM is just trucking. Up into the 15s now. Already I'm down 80 cents a share once again. Now almost $1. And yes, this is happening fast, but I should be capable of covering into that high a day break. This is me just completely failing at discipline. I'm already down unrealized another 5 figures. It's absolutely laughable how bad my discipline was with this ticker. I wish I could say this is a problem I only had with NDRM, but I've been known to do this sometimes. This does happen to me. I will let myself get stubborn sometimes with these shorts on the ones that I feel are just running too much, and all of a sudden I'm in a world of hurt. This NDRM spike is still showing no signs of stopping, and I'm still holding my position stubborn, just like last time, hoping for some kind of dip to let me out. Seems to be going the opposite way though. I'm down almost $2 a share. Remember back at $12 when I felt like this was up too much? Now we're in the 16s. I'm down over $2 a share. The stock is up almost 170% on the day. I started making assumptions about what the stock could and could not do, and I'm getting knocked on my ass because of it. A bit of a pullback here from $16.70 down to now $16 and 15.80s. So this is a dollar a share crack right here. And now even more. This just went all the way right back down to 15. Just faded back $1.50 a share. Could have been great to cover into and minimize losses. And then I could have let this thing spike, re-shorted into a lower high, risked off a 1673. But so far, I've done a terrible job of respecting my risks. And instead of covering, I actually start trying to add right here at 1568. Put in an order for 5,000 shares, which when you think about it, really isn't that big of a bounce. But so far the ads, they're working out okay. We were fading back a little bit right here. Back into the low 15s and looking like we might snap 15 even. And we're down into the 1490s. My average was up to 1485, so I could be out for minus 5 cents a share and I could be out for minus 10 cents a share. Since this is such a hard crack, I still want it to turn into a gain, or at least into break even. I'm saying to myself, okay, that was a really hard crack. The top must be in now. So I'm just sitting back, trying to be patient. NDRM is just kind of in a choppy phase right now. It bounced back to the mid 15s, faded back to the low 15s now. But I'm just holding out and I'm looking for low 14s or mid 14s to cover so I can actually have a gain. NDRM perks through 1550 now though. And suddenly starts flying on up. We're retesting the $16 area now. So it's having a real bounce now after that really hard pullback. $16 did reject the first time, but those mid 15s held up well. We're starting to see higher support. Again, this is where the trend is changing, and I'm kicking myself for not downsizing into dips. NDRM busts through 16, and all of a sudden we're within 50 cents of high of day. We start seeing some prints in the 1660s on NDRM, and I'm basically just holding my breath, hoping that this doesn't start ripping another leg up, because I'm going to have to cut it all again into strength if that high day breaks. I can't just let this keep going and going against me. We have another dip here under $16, but I don't want to take this. I want it back down in the high 14s like it was before. Mid-15s did hold up well there. And now we've perked back through 16 again. And it's starting to look really threatening that this might break to new highs and I might have to take another large loser. Mid-16s are still putting up quite a fight, despite a few perks up there. We just can't seem to get that crack and start fading off like I desperately needed to. Now as the 1660s start breaking and we hit new highs of the day, I'm forced to take off into the strength. I eat my entire loss at 1685, and that loss is even worse than the last time. I'm now down almost $40,000 on the day. That loss right there was just under $30,000. And again, it's just a horrible lack of discipline to blame. NDRM did keep going beyond my wildest dreams of what was possible. It got as high as 1907. I know it's an extreme example. I know this is one of the crazy squeezers that we only see once in a blue moon. But you've got to understand, it's these once in a blue moon plays that wipe so many traders out. You can be a great trader for 6 months, for a year, for 2 years, but when that one play comes along, you're toast. So this is why rules are in place. This is why you have to stick to rules. And I do a terrible job of sticking to my rules on NDRM and on front side of moves like this in general. So you might be asking yourself, if you're so bad with this strategy, why are you showing it to us? And the reason I'm showing it to you is because this hammers home a very important point as a trader. You have to be able to recognize what is not working for you. Just like I realized that shorting into day one of a big runner based off of intraday resistance wasn't working for me. Why stick with a losing strategy? There really were quite a few problems that I ran into with this strategy. Even the ones that worked, where they turned into big faders for the rest of the day, I would never be in for most of that move. I would only be able to take a small piece and then I would cover because I'd be worried that the chart would base out, it would form support, and then it would rip back into the end of the day. Because the stock was still green, the chart was still intact, and I just was afraid to be patient. I never knew if it was going to come back on me or not, so I wanted to take profits when I had them. So as a result, most of my gains, they usually wound up being pretty small percentage-wise. I usually would make about the same amount per share as I was risking. But the biggest problem, like you just saw with NDRM, is that I just could not stay disciplined with my risk. Sometimes I got away with it. Sometimes losers would turn into winners. And that was great. I loved it. For the entire summer of 2014, that was pretty much the theme of my trading. Going on wild rides and letting losers turn into winners. And I never got burned from it. And then LAKE happened in October of 2014. A stock where I started in way too early short, I got stubborn, I added, stayed stubborn, and then wound up eating about a $290,000 loss by the time all was said and done. I came out of LAKE saying, okay, I can't get stubborn anymore. I have to focus up. I have to cut losers when I say I will. Well, you just saw NDRM. NDRM happened months after LAKE. I just couldn't stick to it. I couldn't respect those high-day risks. I kept making the same mistakes over and over and over again. And even if I won 9 out of 10 times with this setup, that one time out of 10 that I lost, or even that one time out of 50 that I lost, would wipe them all out and then some. So I recognized as a trader, I could not trade like this anymore. After NDRM, I started enforcing the rule for myself that I would not allow myself to short day one runners based off of intraday resistance. I didn't want to try to play those lower highs anymore. In a lot of cases, I wouldn't even let myself play the front side of the move if it was day 2 or day 3 of the spike. I wanted to be very, very careful unless the stock was just ridiculously overextended. As a result of this, I cut out a lot of losers. I had a few straight months with no large losers, and I felt like I was trading very well and putting myself in far fewer stressful situations. Unfortunately, once again, discipline came back to bite me though. In May of 2015, PBMD happened, a stock where I, for whatever reason, found myself short before this big up day because I was bored. I shorted the stock into the end of a day one spike because I just figured, what the heck, maybe it will gap down. I just took a pure gamble trade, and then when it had the large gap up the next morning, instead of cutting my losses, instead of saying, wow, that was a dumb trade, I chose to fight it. And then I found myself in the exact same situation as NDRM, where I was making assumptions about how high the stock could and could not go, adding to a losing position, and eventually eating a loss just under $190,000. So even after the Lake bloodbath, even after the NDRM bloodbath, that still wasn't enough for me. I still found myself fighting PBMD and taking a huge loss on this stock that went from $2 to $6.50 on day 2 of a move, although it was the first day it traded very large volume. Point being, you cannot underestimate how tough it is to manage your emotions, to manage your rules, to stay disciplined. That is going to be the hardest thing you all come across as traders. I hope all of you have to learn far less hard lessons than I did, but there will come times when your rules are tested, and what separates the winning traders from the losing traders are the ones who are able to stick to their rules consistently and keep themselves from fighting stocks over and over and over again. The one thing I will say to my credit in all these situations is that even though I ate huge losers, it never was for more than a quarter of my account. I would eventually make myself stop out before the damage got too out of hand. So just always remember that. No stock is worth going broke over. Even if you are in a stubborn situation, sometimes it is better just to eat the huge loss rather than risk losing everything. But when it comes to these big strong green days, when the stock is still on the front side of the move, when it's still spiking strong, especially on day 1, there is still one setup I'll play. That setup is if the stock is spiking into a major daily resistance level, and that is going to be the main focus of Chapter 10. Chapter 10 focuses around shorts into major daily resistance levels, the only day 1 setup I will trade on a runner. The approach is pretty simple. It starts with me identifying a major resistance level on the daily chart. Obviously, not all big runners are going to have a major resistance level on their daily chart to play off of, so that helps me weed down what I should be looking at and what I should be playing. When I spot a stock with a level that I feel like I can play off of, I usually start scaling in short, risking off of the resistance level area a little bit early. What I usually do is I take about half of my position a little beforehand because in a lot of cases, you will see it top out before it reaches that resistance. But I always save myself room, I always save myself another piece that I could add on just in case that spike does make it all the way into the resistance. Then I just slowly cover into the fade once I have my position, paying myself along the way, and in the vast majority of cases, I have nice profits to show for it. My criteria, of course, start with the stock needing to be liquid. I need it to be well above average volume. I want it to be a very liquid stock that I'm playing. Volume is always key for me in order to be interested in making a trade. But the other criteria relates to how I judge a day on a chart as major resistance. I need it to be a day on the daily chart where the stock traded major volume. If there was some kind of significant volume on the chart on that day, then I will risk off of that day's highs. I will consider that my major resistance level. My final criteria is that this most recent run on the stock, it can't be starting from a based out level that is too close to that resistance. Again, close is a relative term. I'm going to look at the daily chart, I'm going to look at typical range, and I'm going to try to get a feel for whether the stock actually has to spike pretty far to hit that resistance point or not. If it starts too close, there's too high of odds for me that it will actually break through and it will turn into a breakout instead. I know all these terms are a bit relative and a bit hard to visualize, so let's get a look at some charts showing you exactly what I'm talking about. First up, let's look at RADA. You might remember this RADA chart from the breakout chapter. Well, on day 2 here, there actually was a pretty good short sale opportunity. It doesn't have to be far back on the chart that I'm risking off of the daily resistance. In this case, it was just the prior day. RADA had spiked to about 330 on day 1 of its move, but then faded off really hard and closed down in the low 2s. So the next morning, after only a small gap up and a spike above $3, we had a clear resistance level to play off of. Yes, this day the volume was much higher than the prior, but you have to consider that on day 1 of the move, that was the most volume the stock had traded in recent history. Another good example of this is CANF. Again, another one from one of the breakout chapters. On day 1, it spiked to about 435 and faded all the way back down to 3. And then the next day, after a gap up to about 320 or 325, spiked back over 4, and again, a clear resistance level to play off of now, the previous day's highs, because it had closed so far off of those levels. Now, like I said, both of these charts were in the breakout chapter, which means eventually those highs did not hold. So I am not playing these with the assumption that that major resistance will never break. Sometimes it does, it is possible. But the first time it tests those levels, I don't expect it to, and that's when I'm taking the short, is into that first move up there. Taking a look at a little bit longer term of an RADA chart now, and this demonstrates another situation in which I'm very comfortable shorting into spikes into resistance. Take a look back at the end of September on this big green day, the first day since RADA's big fade that it had any kind of major volume and had any kind of major run. And that topped out perfectly at $4 and then faded off. Well, fast forward to November. The stock had a spike that morning. You can see the top wick of that big red candle. And that topped out in the high 370s and then faded off all day sub 3. That's an example of a spike into the resistance area. And that $4 resistance from back at the end of September, it held. Again, you see it in the beginning of December. A big spike up from the mid 2s all the way to the high 380s. And the next day, it couldn't break through 4. It actually gapped down a little bit and faded back off sub 3. So both of those spikes, those days where it had big volume, I could have easily been shorting into the high 3s there, risking off of that $4 high from back in late September. DGLY is another great example of this. It had its first run in July all the way up to about 930. And then it topped out, it faded off for about a month, back down into the 4s and 3s. In August, it had its second run. It had a big green first up day, going from the 3s up to a high of $7 where it closed. The next day, gapped up large, spiked up towards that $9 area, and again it failed. It failed up near 9, didn't make it all the way to that resistance at 930, but came close, and then it faded off all day back to sub 6. And I remember this is one of the first shorts I really had success with this strategy, because I got short into the high 8s, playing off of that 930 resistance area from back in July, and I faded it almost all day. I managed to stay patient with DGLY, and I had some pretty nice profits to show for it. Once again with DGLY though, you'll remember this from the breakout chapter. Eventually it does get through those highs, and it does have a crazy squeeze. So it's very important to respect risk on these. Because I know the potential these things have if they have those breakouts, it is much easier for me to respect risk in this approach. Unlike the first approach where I'm just risking off of an intraday high and I have trouble respecting my risk, I have trouble cutting losses, I know that these breakouts can really burn me. So if I'm wrong on these and I see the level break and I see it holding, I'm getting the heck out of there. I don't get stubborn with these because I just have far more respect for the setup, and that makes it way more feasible for me to trade because I can follow my own rules. Another example of a short into resistance is ABIO. Take a look at this most recent day on the chart on ABIO. The stock opened up just above $1 and appears to have spiked all the way up to about 118, judging by that long top wick on the daily candle. That 118, well, it fell just a few cents short of the big volume high back in December at 125. Shorting into that morning spike with a 125 risk would have been a very clear-cut play. Let's take a look at it intraday. And here you go, you can see this action, crystal clear. A big 3-minute spike at market open to that 118 high, and then just faded right off, and then even broke down slightly further by the end of the day. I have no problem taking a short into a spike like that. A lot of traders want the sure thing. A lot of traders are scared shorting into that spike, saying, how do you know that it's going to hold? How do you know 125 won't break? And the honest answer is, I don't 100% know 125 won't break. Nobody does. Nothing in trading is 100%. But I do know that the vast majority of times it will hold, and in the times where it doesn't, I will get out, and I will take a small loss. One last example to look at is MCP, and MCP is one that I traded recently, where it had a huge gap up on day one, spiked from the 70s up to almost $1, and then the next day, gapped up again. And going into this second day, I was watching MCP based off of its February highs in the 113 area. It had been trading above average volume all of February, and that was where the spike topped out at, was 113. So I knew that I wanted to short that next day if it gapped up and spiked up to those levels. Let's take a look intraday at exactly how I approached this. And we had that gap up. We had that straight up morning spike. For a while here, we chopped around and topped out at 112. And during that time, I was working into a short. I worked into a very sizable short with a 109 average. And then we did have that brief perk through 112 and that 113 level I wanted to play off of. I did not panic out into strength. I was not out the second it was through 113 freaking out and saying, oh my gosh, it's breaking, I'm in huge trouble. I let it test. I wanted to see how strong of a break it was going to be through. If it had spiked strong, maybe up to 120 there, I'm likely taking my position off into dips, or at least downsizing considerably. But instead, I saw 115 stuff. I saw a hard crack right after that, and I was able to sit back with my position, be patient, and cover in pieces on the way down. Now let's get a look at some live trades showing this shorting into resistance strategy in action. First up, we'll take a look at VGGL. If you take a look back on VGGL, you might see quite a few resistance points, mainly in the $5 area. But I'm more concerned with the most recent one, the one towards the end of December, where there was a little bit of a volume burst after about a month of inactivity. And that spike topped out in the mid threes, about 350 it looks like. So as VGGL is having its morning spike here, I'm interested in that 350 area. I think that 350 will be the major resistance point that will hold this down. And I'm going to go ahead and go about my strategy of scaling in along the way. The spike so far this morning has gone from 250 up to a high of 315. Right now, I'm just watching VGGL hoping that it can push higher, because the closer to that 350 it gets, the better it is for me and the more size I can take on my position. Just yesterday, VGGL did close at 228, so it is already up quite a bit from previous close. I took my first 10,000 shares short there at 304, so 40 cents a share below that resistance level I want to play off of. The reason I started in there was simply because after that failed perk up to try to break past 315, I thought, oh no, VGGL might be tired. I started wondering if the top was already in, if that 315 was as high as it was going to get. So I took my first small piece just in case. Because like I said earlier in the chapter, these do stop short quite a bit. But if I'm wrong, if it does continue squeezing up, if it gets past that 315, 10,000 shares risked up to 350 is not excessive risk for me. I will let it run and I will not put any ads on unless this can get up into that 350 area. So I'm very comfortable with my position right now. I know how I want to manage it. We briefly were under 3 there, and now it's perking right back through. So looks like I'm in store for a bit of choppiness. As far as covers go, I see that there's support down in the low to mid 280s from that previous dip. And after that, the next support really isn't until the low of day at 251. So as we get near these support areas, I will slowly pay myself and scale out along the way. So far we're hanging out in the low 290s and I'm up over a dime a share. Let me crack under 290 briefly, start heading a little bit lower even. So it looks like my call to take that starter at 304 was an okay one, because this is a pretty big fade off of that 315 high at this point. And it significantly decreases the chances that VGGL is going to ramp back up and break past 315 later. So as VGGL determines which way it's going to go, I'm going to go ahead and speed action up just a little bit more, just so we don't have to sit watching consolidation for too long. Start to see further crack out of VGGL here. We're down into the 280s now. And under that first support area I was thinking about earlier. Since it has faded pretty well off of its highs already, I take off a third of my shares. I took them off at 285. So 30 cents a share off from the highs and about 20 cents a share off from my entry. I lock in along the way just so I can help myself stay patient with other pieces. This could still put in a long consolidation and come back and break past 315 in an hour or two. I don't want to be stuck holding all 10,000 of my shares when that happens. And this action is part of what makes NASDAQs so different from OTCs, because OTCs pullbacks like this tend to be a lot more severe, whereas with listed stocks it's a more slow, gradual fade. $280 cracks there, and it looks like we might start getting more washout. So far this fade down has offered no real significant pops. Nothing to scare me out or nothing to tempt me to put on an ad maybe. All these little pops are just a few cents a share so far. I'm still sitting patient with 2/3 of my shares, hoping I can get them off closer to that 250 area. Here we go, we're back under 280. Now it starts to dip a bit harder. $280 just acted as a top on that last round of perk. So hopefully right here on this pull, 275 retests and snaps and we continue to fade off. Here comes that 275 retest and we're under. And as we continue inching down, I consider taking off more shares. Right there I did. I covered another 3,000. So now I'm down to just 3,500 shares open. Just because these are really slow cracks, it is really slow fade, not panic. This has pretty much been nonstop fade for the past hour. And I figured that at some point this trend is going to reverse. But instead we continue to just slowly melt away, and I have sped time up again here. Because I do hold this last third a little bit longer. Like I said, taking off in pieces so I can stay patient. We briefly cracked under 270 there and reclaimed. So I put in a cover order for the rest of my shares at 270. My profit finger gets a bit itchy and I'm satisfied with my gains. So I'm just sitting back now, trying to get out the rest of my shares. Unfortunately, only about a third of that order executed, and now we're ramping up a bit. We dip on back down though, hit 270. I cover up and I'm flat with just under a 10% gain. Taking a look at the end of the day, it's too bad that I couldn't stay patient because we did fade all the way below low of day, got down as low as 237. So this turned out to be a fantastic fader. And while it didn't reach all the way to my resistance level, this trade was still based off of that idea. So a well-calculated short. I didn't get a ton of size behind it because it didn't quite extend enough, but I'm happy with the gains I locked in and I'm moving on to the next one. At first glance, looking back on the ABIO daily chart, it might not seem like there's a very clear resistance, but look at where the one big volume candle was back in October and where that topped out just above 140. That is the daily resistance level that I want to play off of. So now this morning as ABIO opens and it is spiking on day 3 of this up move from a base of 70 cents, I want to short into that spike and risk off of that low 140s area. And I'm going to build in as we go. I know that there's a decent chance this spike stops short. So I'm going to take a starter before we get to 140, but I will save myself room to add just in case it does keep on pushing. Already I feel like the move is getting a little tired near 120, so I have my first 10,000 share starter in at 117. This is a setup where I'm comfortable to go up to maybe 100,000 shares. So I've put in 20,000 shares so far at a 116.5 average. about a fifth of my size that I'm willing to go. And I'm putting another ad on right now at 119. I have another 10,000 shares open there. I'm looking for this 120 area to fail, and then hopefully we get our fade off. I filled the rest of my 119 order though, and then we uptick quickly through 120 and perk up to 125. I have 30,000 shares, I'm a little underwater, but I'm really not panicking at all here. We still have plenty of room to go until we get to that daily resistance level, and I would have to stop out. And I'm really only in about a third of my size so far. So I'm going to use my ads wisely. I want to make sure I have at least about half size for high 130s or low 140s if it does somehow get up there. So the ads I'm going to put on down here, I am running out of shares. Right now, despite that perk up to 125 though, it still seems like ABIO is struggling a little bit. It briefly slapped back under 120 there. For now it's reclaimed, but I decided to put on more shares at 121. For now I'm up to 37,000 shares. Just a couple thousand shares left open on my order. Right there I fill the rest. Now I'm 40,000 shares from a 118.25 average. This is day 3 of the big up move. With every passing day, I expect pulls to get more and more severe. But really this whole trade idea is centered around that low 140s resistance level from the last time we had a big volume candle. And we're back under 120 right now. And I'm just trying to sit back and stay patient and give this a chance to fade. So far, so good. We're looking pretty weak. 116 bid being tested. We have a little perk here back towards 120 area. But for now it's stuffed and we're right back on the 116 bids. I'm up a couple cents a share on my position so far. And just waiting it out, like I said. Thinking that we should start to get some serious fades soon. Even if this consolidates and grinds back up and breaks past the current high of 125, I will welcome that as a chance to add. Instead, we start to crack some more. We're down into the 113 area briefly, and I really speed up time here now. Because this is a long patience play and I don't want to make you watch hours of consolidation footage. I covered up my first 5,000 shares there, and another 5,000 right there around 110. I'm starting to slowly pay myself into the fade down because we're just above low of day. Low of day is the first support level I can think of, so I want to make sure I'm taking a few shares off right above it. But once we're under low of day, the next support should be the green-red area. Previous closing price was 98 cents. Although we have a little grind back up here, I'm really never tempted to cover into the strength. A choppy fade is to be expected, I think. The bounce did get into the high teens there, but couldn't even retest 120. Start to get some further crack here, and now we're right back on the lows of the day. So that ABIO bounce might have even been a good adding opportunity. ABIO breaks below 108 and we're at a new low a day. Had a slight speed up to the downside there, down to 104. I'm holding off on my covers though. I want this to get a little bit closer to that green-red mark, or at least a $1 test. After a pop back towards 110, ABIO starts fading off again a little bit. But like I said, this is just a slow and choppy one. I really am just trying to sit back and be patient. And you're seeing a lot of the day in just a couple of minutes here. It's already 1:30 market time on a trade that I started right near the open. I did cover up 10,000 more shares into this sideways consolidation because I'm getting frustrated that it's not fading off more. And I don't want it to perk back through 110 and still have 3/4 of my shares. Seems like it's trying to weaken again a little bit, but it's just gotten really, really illiquid. And illiquid is when I am not comfortable. Here comes some more fade though, another low a day test, and we had a new low of day there at 103. But I didn't take any off into that dip. I was sitting back, I was waiting, again, just for a few more cents a share. I start putting in cover orders at 106, 107, and 108 for ABIO, just 5,000 shares at a time, trying to get out my last 20,000. Because this is not breaking down like I want, it's starting to grind back. So I'm covering into a perk, unfortunately. And I filled all the rest there right as we faded out. So apologies for cutting that ending off a little bit, but I made it out with about a 7% gain. End of day chart here, you can see that 103 was the low of day. It grinded up a tiny bit into the close before closing at 110. If there's anything I wish I'd done differently on this trade, I wish I'd been better about paying myself into dips rather than into sideways action after perks or into perks. My goal with the trade was to be kind of patient, give it time to work. But once the illiquidity of ABIO started to get to me, I should have recognized that and I should have known that patience was not going to be easy for me. I should have known that I should have been paying myself into the dips along the way, because once I'm uncomfortable, I want to be paying myself into favorable situations rather than making emotional decisions when it starts to look like the stock might go against me. But even though my covers weren't perfect, even though I started in early on my short, I still got out of ABIO with a 7% gain, and this is a great example of catching the meat of the move. Because I traded it far from perfectly, but I still made it out with a nice gain, and that's what trading is all about. Recognizing that you don't need to be perfect. All you have to do is catch a piece of a good opportunity. Let's take a look at a slightly different example now with GENE. GENE is a different example because in this one, we're going to be shorting based off of the previous day's resistance level. Yesterday it had a big run up to almost 770 and then faded off very hard into the close and closed at 614. So well over $1 from its previous high. My plan going into this morning is that I want to short GENE into a morning spike, risking off of that 770 area. And right now we're getting a nice gap up in the pre-market hours, so it looks good that I might get a chance to short around those levels. One thing that's a bit concerning to me is the fact that it's gapping up so much. Basically, it closed $1.50 off of its highs, and already with this gap up, it's made back about 2/3 of that move. So I'm a little concerned that it might be opening a little too close to that resistance level, where it's really not asking for that much of a spike. But since it's been pretty much straight up pre-market on this gap, I still think that there should be some pull beforehand. So I'm not letting this deter me. But obviously, the further it has to spike during regular market hours to get to that resistance, the better in my mind. Market's getting close to opening, and we're up in the 720s on GENE, so this really is gapping up large. Market opens, and there's a little bit of weakness right out of the gate, back down into the low 7s. I'm not shorting yet because I want to see how well dips hold and if we do get that push up into the 768 area. GENE now is reaching new highs a day, and approaching that resistance I want to play off of. The closer the better as far as I'm concerned, and since this was a big gap up situation, I am trying to be a little more cautious. We get some 760 hits, and I put in a 5,000 share short at 757. That's really close to my risk level. I feel good about it. 760 has rejected so far, and we're pulling back into the 740s now. So it looks like that resistance level is going to work out pretty well for me. I don't have much size behind the trade, but that's okay with me. I don't really want to be in a situation where I'm playing this one huge. We're now dipping into the 730s. But 740 is reclaimed. Right now, GENE is just kind of being choppy. And I was hoping for a lower high there, but instead it perked right up into the 770s. And now we're at new highs of the day. And I didn't cut my loss. I'm sitting on my 5,000 share short still. This is just stubbornness. And we even get a dip back into the 760s, which really isn't unexpected. A lot of times you'll get that dip, that second chance to get the cover, but I don't take it. And there's absolutely no reason to be stubborn here because this is a small position. I could have cut that loss on the break past 770. I could have cut it into this dip right here. I'm losing 500, maybe 750 bucks max. 15 cents a share, that's really nothing to me. It's just ego that's keeping me in this trade. I decided to dig in my heels and fight rather than just take the loss and try again later. I really start fighting, unfortunately, because I just put an ad on in the 790s with the hopes that $8 rejects. So now I'm 10,000 shares from 772, and this is no longer at all my short into resistance strategy. Now this is just me being stubborn. This is me fighting a stock that is well through the resistance level that I wanted to play off of and is holding it as well. We blow through 8 on GENE. And all of a sudden, my could have been $500 loss, I'm down $5,000. Once again, there's just absolutely zero reason for me to be in this situation. Now I'm stuck sitting through this big spike, hoping that I get a pullback sometime soon to let me out. These stubborn trades, these really are the ones where the majority of my losses come from. Where I had every chance in the world to get out for a manageable loss, but instead I dug in my heels, I decided to fight, and the stock just kept on going and going. Remember that my plan on these shorts into resistance, they're to build in short based off of that risk level. When I built in short on this one, it was already through my risk level. It was not in my original plan to put on an ad above 770. That level was supposed to hold as a top. I was wrong, but I didn't let myself be wrong. And now I'm paying the price for it. It's not with any kind of crazy size, but still, it's just taking a very manageable situation and making it terrible. We're starting to get some relief on GENE right now, though, dipping back into the low 8s. So maybe it will crack back under 8 and I can take off for my couple $1,000 loss at this point. Or maybe it will even be kind enough to give me break even. Looks like we're about to get an $8 test. Tested at 801 for a second there, but it held. We're pretty much 55 cents a share off of the highs in that last pull. I didn't even downsize. Sometimes as a trader, you will put yourself in stubborn situations like this. Nobody is perfect. I certainly am not. But what I've learned along the way from my trading is that when I get stubborn, when I have a stock go way against me, I need to take off into pulls. I can't sit back and just wait for break even. But mentally, that is such a tough thing to do, and that's why I didn't cover any at 8 there. It's because I wanted to sit back and wait for break even, or at least closer to break even. Hard not to fall into the mindset of, well, now the stock is going my way, so I'll just wait. Usually the way it goes is it only goes your way for so long, and then it starts perking right back up again. And you have to wonder if you're going to get that lower high or if it's going to bust through to new highs and make things even worse. For now, we're just kind of choppy in a channel between that 858 high a day and that $8 area where that last dip supported. We've got to see which way Gene is going to break. Getting another dip into the low 8s here, so maybe another test of that $8 support area. But that time it bottomed at about 810. Another 810 test there, cracked under. Low 8s being tested once again. Once again they hold though. So not the best sign in the world for me right now that we can't break under 8. I'm going to have to sit through more consolidation and hope that we get lower highs and eventually I get that snap and things go my way. So far, this perk's been a little bit weaker. Hopefully this is the lower high I need. And then we get that snap and I can cover up. Instead, it goes the other way and starts perking up strong. Back into the 830s. Big offers get chewed through at 840, blows through 850, pretty much retesting high day. Although it did just snap back under briefly. And I start covering up there. I got out half my shares right as it broke past high a day. Why I'm still sitting on the other half, I really don't know. This is just not even a strategy at this point. This is just me being stubborn, like I said. I am not making rational decisions. Wasn't a very strong high day break. And this time I recognize that I need to get out into the pullback that it offers me. I got filled about half my remaining shares there at 836. And I fill the rest into the dip there, and I'm out, and I've lost just over $7,500. Far worse than it needed to be. Taking a look at the end-of-day chart, it's a good thing I cut the loss when I did, because it got as high as 950. So at least at the second half of my position, I was smart enough to get out into a dip. Even though it wasn't for break even, even though it wasn't even for close to break even, I at least made that loser a little more bearable. But I put myself in a terrible situation for absolutely no reason whatsoever. The stock broke through my resistance. It held my resistance level that I wanted to play off of. Yet I failed to recognize that. I dug in my heels. I fought a stock that was no longer a pattern I'm familiar with or that I like. And I took a loss about 15 times worse than I would have if I had just cut the loss in the first place. Next, let's take a look at NYMX. We're joining NYMX in the middle of a morning spike here. It's run from about $1 up to a high of 173 so far. If you look back a couple weeks on the daily chart, you can see that NYMX, it is a former runner. It had a big run at the start of April, getting up as high as about 195 before finally peaking out and fading off on a nice 3 days worth of spiking and very large volume. So today, since NYMX is starting to show signs of life again, and I believe it was due to a press release coming out or something of that nature, I'm looking to short sell this with the idea of building into a nice position up to that 195 resistance area I want to play off of, using that as my risk. I actually did just take a starter of NYMX. I took 20,000 shares at a 166 average. I took that starter because we did just have a hard crack off of the 173 level down into the 150s, so I wanted to start building into the next pop, just in case that 173 high is what wound up holding. Right now we've perked through, we've hit a new high of 174, and I've added a few shares to my short at that 173 mark. I'm up to 28,847 shares so far. This is probably about a third of the size I'd be willing to go on this setup. So this is not at all a crazy starter for me. I have a 168 average. That's only about 25 cents off of the resistance level I'm playing off of, and I have plenty of room to add in case this spike does keep going higher. For now, we're getting a second pullback on NYMX though, and it's looking like this was a pretty solid starter. Another pretty hard crack off of the high of day break attempt. And I actually take some profits right into this first pull, just to downsize, just to pay myself a little bit. I get myself back down to 20,000 shares. That first piece I locked in about 10 cents a share on, so that was roughly a 6% gain on that first third that I just took. As NYMX develops now, I will continue to watch pops for shorts, and there's a part of me that is hoping that this does have yet another push higher. I want it closer to that 190 level so I can really size up. get a ton of size on my short, very close to that risk level. But since I am playing kind of far off of the risk level right now, I do have to play it a little bit smaller. I don't want to risk 25 cents a share on full size. NYMX is slowly grinding back up into the 160s now. There is a part of me tempted to add some shares into this pop, but that would be more of a strategy I'd use if I were playing off the 174 level. Like I said, I want to keep my size smaller for now since we're still pretty far away from that 190 level. I'm hoping that this isn't done. This is still a solid green day. This is still up a lot, and I just want that one more push. So I'm going to wait on ads until we get that higher price where I can really get some size close to my risk level. If it doesn't have that next push, if it does just fade off, in that case, I'm happy because I still have 20,000 shares short. My starter will pay me nicely. I can just cover it up on the way down. Either way, I feel like it's a win-win. The perk through 160 was a bit weak, and now we're fading back off into the 150s. So it looks like we might be setting up for another leg down here soon. Right now I'm up just about a dime a share on my position. So I'm hoping for some further crack, get me down closer to the 140 area. I don't expect this to just crack off and fade all the way back down to that 110 or 120 area where this squeeze started when the news came out. I don't think it's going to be straight up and straight back down. I think that's too big of a retrace to be asking for or to be thinking that I want. So I'm going to play a little more conservatively, and I'm going to look to cover when it gets down to about that mid-range point, that 140 mark. That's what I'm shooting for. NYMX continues to weaken. Right now, about the only thing holding it up is that big bid at 155. That big bid is causing it to perk a little bit right now. We're getting another test on the 160 area. But again, this is just not a setup I'm sweating at all at this point. Whether it spikes to new highs, whether it collapses, I'm happy to be patient. There's that perk back through 160. And now 165 is being tested where that last perk peaked out at. So this might be about to get bullish again. You get that perk through 165 and now it's back up near 170 and testing 170. So this is great. It looks like we might be about to keep going. I can get my size higher like I want, hopefully. Back at that 173 mark. So we're almost at a new high a day. I'm not adding here just because I want to see how high a day responds. Why use my ads here when I might get the chance to use them higher in the 180s or 190s? But 170 failed that time. Now we have a double top up in the 174 area. And that's a pretty hard pull back down into the low 160s. I covered another 5,000 shares into the dip, because I do think there's a decent chance this could turn into a higher low and then we get that push. So I'm just trying to position myself in case that 175 break happens. The more shares I have free to add on up into the 180s and 190s, the better. Covering 5,000 shares at 162 That's still a profit for me. NYMX, just like that, is back down into the 150s now. So it's stuffed that high day break attempt and really has just gone nothing but down ever since. But it still is above that key 155 number. I do anticipate further fade if or when 155 breaks down, once that big bidder is taken out. And given the channel that this is trading in right now, between 174 and 155, I have a good average with the shares that I'm still short. I'm short towards the upper end of that channel. So it's really just a matter of patience right now. If I'm going to be covering when it's within this channel, I want it to be into dips. I don't want to chase those perk ups and feel like I have to get out into the strength when no real key level has even been broken. Right now, though, I'm managing to stay patient with the last half of my shares. While I am trying to be patient, I am noticing that 155, it is even getting tested again after that pull. The high 150s are holding very well, despite this big offer at 160 in there. So right there is where I lose patience. I covered up into that offer at 160. Because in my mind, it was in the lower end of the channel. It wasn't breaking down like I wanted to. It was holding above 155. So the door was wide open for it to ramp back up, hit new highs, and then I could just reshort higher. So I covered in the low end of the channel with that as my plan. I wanted that opportunity higher. Unfortunately, that opportunity never came. My 160 cover was okay because we did ramp back up one more time around 11 o'clock, almost tested that 174 area, but it failed once again, and then it finally cracked off and faded down into the low 140s. So I could have gotten a bit better of a cover. I simply ran out of patience in the 160s, but because I did cover at 160, I might have saved myself from a cover up near 170 when I was wondering if the stock was about to break out higher. My plan was I wanted to risk off a 195. I wanted to build in up to 195. And then I wanted to stay patient and give the stock a chance to fade. Unfortunately, I ran out of patience. I decided I'd rather cover up my shares with the chance to reshort higher if the stock did break past 175. And when that break didn't come, I was forced to just watch the stock fade without me. All in all though, it was still a nice gain. I still made about 6% on the trade. I just made the wrong call thinking that I'd get the chance to reshort closer to 195. The final example we'll be looking at is BIOC. BIOC was on my radar because yesterday was a huge up day for it and it traded major volume. It was one of the top results on my typical scanner that I run every night. This morning, BIOC is having a huge gap up. It's on track to open in the 380s. When it was spiking yesterday on day one, I knew that I wanted to try to play off of either the 370 area or the 410 area. My lean was towards 410 because that was the days where the bigger volume had traded. Today, since it is gapping up huge, that answers my question. It's already through 370, so I'm going to play off of 410. After BIOC's first big run and fade, it perked back up off of the high $2 area and for 2 days rebounded, topping out of that 410 on major volume. So today, I expect 410 should give it trouble again, and I plan to short into a morning spike, risking off of that area. Market opens now, and immediately we do start spiking towards $4. Since I'm not sure if the spike will get all the way there, I take a little bit early of a starter here at 396. Like I mentioned earlier in the chapter, I will take early starters. I'm okay doing that. I tried to put in an ad at 405, just 5 cents below my risk level, but I couldn't fill any. I threw in another order down at 402, but the stock just pulled too quickly. I'm leaving those orders sitting there though because right now this is just the first hard pull retesting that opening price area. If we pop back up through 4, I'm okay with those orders filling. And that first dip did hold well, and we start pushing back through 4. My 402 is filled, and right now my 405 order is filling. And I'm now up to 60,000 shares from a 401 average. We very briefly perked through 410 there, tested 411. And yes, it perked through my risk level by a penny, but this is another situation where that's not the end of the world. That's not freaking me out. If this were to consolidate in the 3s for a little bit now, or low 4s, and then build back up and start breaking through again, I would be downsizing, or I would be cutting my entire loss. But that little penny perk through doesn't scare me, and it's encouraging to me that it slammed right back down. I am sitting with another ad order right now at 407, just below that high a day, in that 410 area. I started filling a little bit there on that last push back through 4, but didn't get my entire order filled. But I am up to 67,800 shares from a 4017 average. BIOC again fails to hold 4 and is dipped back into the 390s. Now the low 390s. So this is starting to look pretty weak. And I do cover a small piece there just to get my size down a little bit. As we crack under 390 and into 380s, I start paying myself a little bit more along the way. I've now gotten myself down to 54,000 shares. I'm taking off some of those early shares that I had shorted at 396. So now my average is 4032 on the remaining 54,000 shares. My order is still sitting there for 407 to sell more, but I doubt that we get a push that high. Right now, BIOC just having kind of a weak rebound off of that 380 area. But that did briefly crack below low of day. And even though it's perking now into the 390s, I'm still not really all that worried about this stock. I'm really happy with the way that 410 held. And I have a very, very clear risk, and it's only 7 cents a share. We continued dropping. We cracked under 380, and I covered up another piece at 377 and another piece there in the low 370s. So now I'm down to 42,000 shares remaining, about 2/3 of my original position. Taking off these little pieces along the way will help me stay more patient later with the remainder of my shares. I start covering more shares at 364. I'm down to 36,000 shares now, slightly over half position. And the gains are adding up along the way. I was very comfortable going big on this one because I really trusted that 410 risk area. I knew that my risk was under control. It was less than a dime a share. And the stock is so liquid. It's already traded 6.8 million shares on the day. So I can get in and out of that kind of size with ease. We're getting a bit of a rebound now off of the low 360s. If I were thinking about an ad in this situation, I'd be wanting this to get as close to that last failed perk as possible, the 395 area. I could even possibly move my risk down to there at this point. I put in another cover order at 366 and 367. I took off 1/3 of my remaining shares about, getting myself down to 24,000 shares. The reason I covered so many here was because that was the first hard rebound the stock has had, really. I don't know if we're going to start grinding and consolidating above 360 for a while. So I want to make sure that I'm mostly paid, and if this does happen to grind back on me, I've already locked in quite a bit in profits. Covering there also gives me the flexibility to add bounces if we do get any good bounce up towards that 395 area. But because I've covered up a lot, because I've paid myself a lot, I can be patient with the rest of my shares now. I have nothing to be afraid of. Right now, BIOC is just kind of going sideways in the low 370s, stuck in a mini channel between the 363 low and that 380 last rebound high. You start to get a bit of a perk up here now, and it looks like 380 is going to get tested. Briefly, it breaks through right now. It does slam right back under, but it looks like this rebound might start ramping back up towards that 390 mark where I want to reshort some shares. First attempt is met with a hard pull. But the mid 370s are holding well into these dips so far. We're into the 380s again. And I know right now if I still had my full size, I'd be really stressed out. I'd be wondering, what the heck did I do? Why didn't I take any off down in the 360s? What if this is starting to grind back on me? It's a lot easier for fear to take over. But right now, I am so comfortable. And if anything, I'm thinking about adding into this strength, not covering. Briefly in the high 380s there. So we are getting close to that level, that last perk top. In another account, I actually did put some ads on right here. The IOC cracks back under 380 for a minute here. It's really just a choppy, slow consolidation right now. And then we get a hard crack, right back down into the 360s. That's a bad failure right there for BIOC. To be right back on its lows like that. Now it definitely looks like I could use that 395 as my new risk, or I could even use that 388 area where that last spike perked up at. As this crack back towards the lows was happening, I did cover up all of my ads that I put on in the other account. I know I don't have that on video to show you, but it really was just a quick scalp trade for me. I think I made 10 to 15 cents a share on it overall. I was kind of conservative with my covers. And meanwhile, I'm just sitting back on my 24,000 that I'm still holding from the 405 average. I'm hoping that this will pull back down towards the green-red area, previous closing price of 336. Since the 60s are still holding, I look to take off another small piece of BIOC and I get myself down to 20,000 shares. Just in case this turns into a double bottom here. We had another brief perk right there. We're testing the 370 area again. So it's trying to reverse off of its lows right now. But it slams right back into the low 360s, testing that 363 low a day. And we snap under and head to new lows. Quick dime a share washout right there, so I take off another 5,000 shares into it. and another 5,000 shares into the 340s. I'm paying myself into the washes, and I'm left with only 10,000 shares remaining now. One thing I haven't preached enough through this DVD is that what I'm doing right now works for me. It keeps me emotionally comfortable, but do what is right for you. You do not have to scale in and out the same way that I do. For a second there, a large offer came in on BIOC. Saw it flash a couple times at 350. And there it is again at 352 now. The offer gets taken out, but I am thinking about how that didn't just crack that 340s level. It couldn't scare it down. It's testing again right now, near that 346 current low. But again, 346 is holding. So at this point, I decide I want out the rest. I put in an order at 348 for my last 10,000 shares, and so far I've filled about half of them. I don't like the inability to break below 346, and it really is just a dime above green-red at this point, which is a support that could very well hold. So I'm happy to pay myself the rest. I wasn't filling the rest of my 348s, so I smacked the offer, took off the rest, and I'm flat with about a 10% gain, which I am very happy about given the size that I played. Checking the end-of-day chart now. Once again, I wasn't as patient as I could have been. Shortly after I covered the last of my shares, we did dip into the 330s, and then I failed to reshort on the rebound into the mid-360s. I was hoping that rebound would take us a little bit closer to that previous 380 area, so my risk wouldn't be quite as wide. End of day, BIOC did go red. It had that big crack and tank, and since I don't short weakness, I missed that move. It dropped the rest of the way without me. But that's all right. I captured a great piece of this trade. I'm very happy with what I accomplished, and I'm looking forward to the next one to do it all over again. Let's recap some of the key takeaways from chapters 9 and 10. First, and by far most importantly, you must respect risk on the front side of a move. When a stock is spiking, it can get really out of hand. It can go way further than you think. So do not get stubborn like I do. Cut those losers, knowing that you can always re-attack higher. Also remember that you should be aware of your weaknesses. Learn where you fail, and then make changes. I stopped shorting lower highs for a few months and traded much better as a result, but then slipped back into my old weaknesses and took another huge loss on PBMD when I lost discipline. If you can identify areas where you're failing, simply cut them out of your trading, and hopefully you can do a better job of keeping them cut out of your trading than I did. We also talked about how shorting into daily resistance levels is the best risk level to play off of. Those are much more reliable and hold much more often than intraday resistance levels do, but sometimes they will fail, and again, you need to cut losses when they do. It doesn't matter what the setup is. If your risk level is breached, get out. Finally, I just want to make sure everybody understands the key difference between planned ads and fighting a stock. When I was talking about shorting into daily resistance levels, every time I knew going in what my risk level was, I knew that I wanted to build in short along the way. I was planning to add from the start. When I got stubborn on stocks, when I opened myself up to big losers, that is when my risk level has already been breached, the stock is no longer within my plan, and I start averaging up just for the sake of trying to get out with a winning trade. I start fighting the stock. It was not planned from the start to put those ads on, but I did it anyway. That is the dangerous way to trade. That is the much riskier setup. So just make sure you can differentiate between the two and be very honest with yourselves in the moment which approach you are taking. Chapter 11 focuses on shorting overextended stocks that gap down the following day after their run. One of the first times I really feel like momentum has broken on the chart. But before we get too much into this strategy, let's review one more time what exactly overextended means to me. For me, overextended, it really is a matter of feel. It's a lot of consecutive green days without the stock going red. Or maybe there was a brief green-red move one morning, but the stock recovered and is still closed green. I want a series of up days in a row. Or I want it to be up a lot from where the run started. What's a lot? Well, I guess the question I ask myself is, does the stock have room to come down? So when it comes to shorting the backside of a move, I really am looking for that first time that the stock is red. Red is a big momentum shift when it goes from having been green day after day to finally having a day where it is opening down. It's the first time longs have a real reason to worry. It brings a whole lot more sellers in. It's a sign of momentum turning, you get a lot of profit takers, and if it is a daily chart that truly is overextended, there is a lot of room for it to come down and correct. Now, the first time the stock is red, does that mean that it's toast? Does that mean the play is over? Not necessarily. Like any other setup, you have to respect your risk. But I do believe that the odds are more in your favor, and that's why I will trade red days a bit more aggressively than into parabolics. I'm going to emphasize this one more time. It has to be an overextended daily chart for me. That is what I feel like really puts the odds on my side. The fact that that stock has room to come down. It doesn't matter how legitimate of a company it is. It doesn't matter where it's going to be in a year from now, 5 years from now, 10 years from now. All that matters is this short-term price action has made the stock run too far, too fast, and now that momentum has run out, we're going to get that correction. So after the stock has had a nice big run on the daily chart, and we're getting that day where it's gapping down, I'm usually looking to build short into any morning push, risking off of the red-green area, the previous close. A lot of times you will see these have those quick pops in the morning, and then a nice fade off the rest of the day, although it usually is a bit choppy. I try to cover into pullbacks along the way so that I'm not taking emotional covers into pops later. I don't like covering into strength. But if I do see a perk back that is starting to hold, we are starting to see higher lows, things that are bullish signs, I will be careful, I will get out. There are a couple main reasons I do focus on gap down plays as opposed to a strong stock going red and finally getting weak. First reason is just because right from the start of the day, overnight longs are screwed. Anyone who was in it overnight looking for a gap up, anyone who's holding their long from a better average, again, looking for a gap up, looking for more continuation, this is the first time they've had reason to sell. They're saying, wow, this stock for the first time today, it's not opening green. And everyone knows it's come a long way very fast. Everyone wants to pay themselves before it comes right back down. So it really does tip the scales in favor of the short sellers and put the odds on our side for the stock to have a nice correction and fade. And then after that correction, where it goes from there, who knows, who cares? I've had my part of the play I wanted, I've paid myself. But the other reason I focus on gap downs is because I don't like shorting weakness. I don't like shorting those stocks that started the day well with a gap up and then spiked and then faded off and finally are going red. I feel like they've come down a long way off their high. I feel like I'm chasing weakness. And as a short seller, I've just trapped myself into weakness far too many times. I just do not short weakness anymore. I do not short breakdowns. I've seen far too many fake breakdowns and I'm far too frustrated by it. So now, I would rather let the stock have a hard crack without me and short into some kind of strength after that. The final reason I look a lot at gap downs though is because it's a setup I made myself study and track. I used to be the opposite. I used to not be comfortable on gap down days. I used to feel like, oh no, I missed the play, or oh no, the play is ruined. So I put in the work to make myself understand it better. I started tracking plays on a spreadsheet. First I looked at some old gap down plays that I remembered. I wanted to see ones that came back green. I wanted to see ones that faded off all day. I saved charts. I tracked performance. And then I started doing it again at the start of 2015 from scratch. I built some fresh data so I didn't have the hindsight bias in there. And I went through it all again. I put in the work to get a little bit better of a statistical understanding of this setup so that when I saw it in real time, I would feel better prepared and know how I wanted to handle it and not feel like I'd missed my chance to short a big runner. Let's take a look at some of the data I've tracked for overextended gap downs over the past 4 months. Like the spreadsheets we talked about in chapter 4, I'm tracking a lot of basic stuff. I'm really not going too in depth here. Most of this you can find just by looking at an end of the day chart. If I feel it's an overextended daily chart, and I see it gapping down the next morning, and at 9:30, the first print of the day, makes it a gap down, it gets added to this list. Now, I did need a percentage threshold to consider a stock overextended, so I just used 50%. That doesn't mean that a stock has to be up 50% or more in order for me to play it as a gap down. There are cases where I will play smaller runs. But for the sake of my tracking, that is what I wanted to use, that 50% number. So of course, I'm going to look at information such as the previous close or the previous high. I want to see those numbers. I want to be able to track how the stock reacts to them the next day. Then, of course, where the stock opened, what its high was, what its low was, and where it closed. And then I added in a little bit of extra data here. I wanted to know what its high in the first 10 minutes of the day was, what its high in the first 30 minutes of the day was, and then what its morning low was. And morning low I kind of loosely defined, but I just used it as where did it bottom out, and then spend a little time consolidating after that within the first hour or two. I don't really have a strict time frame to consider it the morning. But this is the basic data I wanted because I could use it to get some valuable statistical information about how these gap down plays typically behave the next day. The next section over of my spreadsheet would have percentages for a lot of these. I would want to see where the stock opened in relation to its previous close. In the first 30 minutes, the high that it set within that first 30 minutes of the day, where it was in relation to the previous close. Also, where it was in relation to the opening price. After the stock gaps down, did we tend to see a spike above where it opened, or would it just be a straight flush down? I wanted to see that. I wanted to know what the high was, the low was, the close was, percentage-wise. I wanted to know where the close was compared to where it opened. I wanted to get an idea if these things typically faded all day. And finally, I'd want to know how far the stock washed out in the morning compared to where it opened at. Finally, here are some of the stats that all that information produced. In 60% of the gap downs, the high of day was in the first 10 minutes of the day. In 75% of them, the high of day was in the first 30 minutes. So in the vast majority of the cases, shorting within the first 30 minutes of the day into spikes like I like to do, I realized would be a good play. Only 20% of my examples actually went red-green at any point during the day. So 80% of the time, using red-green as my risk point would have worked out very favorably for me. After the stock set its morning low, in 70% of cases, it did go on to see further lows later in the day. In 80% of cases, the stock would close within 3% of its morning low, meaning that whatever that morning low it set was, it would either close 3% above that level or lower. So holding to the bell usually would have its advantages. I would not miss a chance at a super favorable cover if I didn't take off into that morning pullback. 85% of these overextended gap downs closed below their opening price. And 100% of the ones that I tracked, they closed red. They did not close above their previous closing price. Now, I can think of some examples I tracked in 2014 that did close above their previous closing price, so that's not to say it will never happen. It's good to know that those are solid risk levels that I'm playing off of, but I still do need to respect them. I can't get cocky and say, oh, well, it's just never going to happen, because eventually, yeah, it will happen, and I need to be prepared. A couple other stats I like to look at. Average morning low related to the open. So after the stock opened, it tended to wash out on average minus 7.5%. Average close related to open, minus 8.35%. So slightly better than the morning low, but not a huge difference. And average days low related to the open, minus 12%. So just because a stock is gapping down, just because you feel like you might have missed the top, that doesn't mean it doesn't have room to come down further. That is what those numbers mean to me. So again, I'm not going to use these stats to make my decisions for me. I'm not going to say, oh, the average morning low is negative 7.5%, so I'm going to put in my cover order at negative 7.5% from the open. I don't think like that. I use these numbers to help guide me, to help guide how I think, to help give me more confidence in my plays that I'm making. But I still want to take the stocks on a case-by-case basis. I still want to be able to make adjustments on the fly. But knowing these numbers, knowing the odds are on my side, it is a major help to me, and it really has helped guide how I trade overextended gap downs. We'll take a look now at some chart examples, starting with CDTI. Here you can see the CDTI setup. It had a huge green day, it had a ton of volume out of nowhere. The previous day it closed in the 160s or 170s, and today it closed at 397, so it is up well over 100%. A nice big runner, nice big green candle. That doesn't mean it can't keep going, but the next day when I see it gapping down, I consider that an overextended gap down. And this is when that strategy comes into play. So looking at the 5-minute chart the next day, it looks like we opened in the 360s or 370 area, had a morning spike up towards that previous close. Previous close was 391, so it perked just barely through, and then fell apart the rest of the day. Got under $3 around 3 o'clock in the afternoon. This was an example of a nice big correction, and that morning entry is about as good as I could ask for, because I like shorting into morning pushes towards red-green. That is my ideal. Another example, FRO. This is one that's been running for a few days on increased volume. At the start of the month, it was in the ones. Its high was 505 on this day. it closed in the mid 4s. Even from the most recent run, it's up from the 250 area. So next day, when this is gapping down, I become interested. Its previous close was 462. This morning it opens around 450. It never has that spike towards red-green like I'd like, but since I see it gapping down, I would typically take a starter in this situation. And then after the morning washout, once we're having a bounce, that is somewhere where I typically might look to add. This FRO example faded off quite nicely, from the 450-ish open all the way down to 380 lows. Next up is CUBA. This CUBA run had started in the $7 area, and over the course of a few days had gotten up well over 11. Once again, a chart that I would see and consider it to be overextended. Here's an example of one though that did not work out nearly as perfectly. It did have its gap down into the 1150 area. It washed out down to 11, but then it popped back. It had its morning spike towards red-green, had its little perk through red-green and fail, and then faded back off into the low 11s and consolidated for about a half an hour. These are 5-minute candles. But then it built back up. It busted through that perk high of day, and then it went crazy. It parabolics all the way up towards the $15 area. This is a great example of one where it did wind up going green and holding green. It did wind up closing green, and it had a very big squeeze. A lot of short sellers got faked out by that gap down. So you have to respect your risk. Moves like this CUBA example are very rare, but they do happen and you have to be ready for them. It's not always just a slow, pretty fade off all day. Let's move on to our next example, IBIO. IBIO had run a couple days in a row from about the 70 or 80 cent area, and it had gotten as high as 270, closing this green day here at about 245 maybe. The next morning, we did get our gap down, so this is the overextended gap down play once again. And once again, we don't get that push towards red-green. It just gapped down and flushed. So I probably would have gotten a starter in this situation, but I wouldn't have gotten my significant size because I wouldn't have had that push to add into. Those are going to happen, but I'd rather be too patient and only have a starter than rush myself in and get myself in trouble when it does have a surprise perk back up. Anyway, this is a great example of an all-day fader, faded from an open of the 220 area all the way down to the 130s. YOD ran from the mid to high ones all the way up to the $3 area. When YOD gapped down the next day, it had a quick push through its previous close at 312. It looks like it got as high as 318. Had a very fast pull after that down to 290, and then pushed right back up again, but held that previous 318 high. So this is an example where, yes, it perked through green both times. I would not let myself get scared out into these perks. Once the first perk topped out at 318 and failed, if I had any shares, I would be using that 318 current high of day level as my risk. So while the second perk back around 10 o'clock did push through green again by a few cents, it never broke through the high of day, and then it cracked and faded right back off before ramping back up towards the end of the day. YOD is an example of one where it did not close at its lows or near its lows really. It set its lows midday. YOD is an example of why it's good to lock in pieces along the way. And you'll see that that is something that I do in a lot of my live trade examples. Another ticker that may emphasize the idea of paying yourself along the way is LAKE. I talked about LAKE earlier in this DVD. It's one that really twisted me on the front side of the move, and I took a major loss on it. By the time it had finally run out of momentum, it had run from the $10 area all the way up to almost 30. The next day after that big run, though, it did gap down. It opened in the 28 area. In 5 minutes, it panicked from 28 down to 23, had a slight bounce back up to 25, and then another round of pull down to 21. That's about a 25% move. But just because LAKE had that big panic, it didn't stay down. It did have a very large midday squeeze and scared a lot of people. After its low of day around 10 o'clock in the morning, it ramped back for the next 2 hours. It busted through green briefly and topped out just under $30. So off of its lows, it squeezed back almost $8 a share. I had to include this example because I really want to illustrate, don't assume that red means that it's toast. Don't assume that just because it's down for the first time, it's going to stay down. While often you get a nice predictable fade, it isn't always that perfect. It isn't always that pretty. And yes, after its big squeeze up, it did fade right back off to its lows of the day. But holding through a squeeze like that is terrifying. Situations like this midday LAKE squeeze have taught me that I need to lock in along the way. I need to take off pieces. I need to pay myself. I do not want to sit and try to get greedy and hold for the whole move, because otherwise I will definitely make an emotional decision into a midday squeeze like that on the rare ones that do. The perk towards green isn't always in the first 5 or 10 minutes of the day, though. It can happen a little bit later. Let's take a look at FXCM, a chart that ran after a huge gap down from about 128 up into the 350 area. So nice and overextended from where its big volume run started at 128. After closing just above $3, FXCM had a pretty big gap down the next day. It opened the next day at 260-ish. And looking at this intraday chart, you can see FXCM, it had a few morning pops where it would fade back off and then pop again to the next high. It didn't get up to its red-green level until about 10:30, about an hour into the day. So this is one where if you take your starter into the gap down, you still need to make sure you size in appropriately and build in appropriately. Because if you went way too big, way too early, as this squeezes closer and closer to green, which is 50 cents away from where your original entry might have been if you'd been shorting near open, you're getting yourself into a lot of trouble. Because if that green level breaks and holds, you're probably going to have to cut your loss, and it's going to probably be a pretty ugly one. So it is important to just remember where your entry is compared to the red-green mark and size in accordingly. FXCM is one where I probably would have taken a starter around the open in that 260 area, but because I would have only taken starter size and left myself the flexibility to add, I would have been ready to attack it when it got up near $3. Now that we've gone through these charts and gone over some of the lessons they have to offer, let's get into some live trade examples so you can watch these things as they unfold and get a better idea of how I make my decisions in the moment. Let's start by taking a look at BCLI. BCLI has the nice overextended setup because in a couple days it's up from $4 to its previous closing price of $7.50. So almost 100%. It's traded great volume, great liquidity, and today it's gapping down large. Since it has gapped down so much already, I don't want to rush into a position. I'm hoping that we can get some kind of a morning push, at least back over 7, so that I can build into a decent sized position, risking off of the previous close 750 area. But since at these levels, all of yesterday's buyers are underwater, I do expect that any pops will be met with nice pullbacks. So I will short into spikes with confidence. I decided to start in short here at 666 because BCLI is ramping up a little bit pre-market. Its low was 630 and now it's starting to show some signs of life. It's starting to perk up a bit. And that area where the last perk failed isn't too much further above that 666 area where I started. It looks like it failed at just about 670 or 675. This is just a small starter size. It is just in case this continues to fade off and I don't get my chance to enter higher. But I'm saving size for that $7 area or $7.50 area. Like I said, right now $7.50 is where I want to base my risk off of. So a nice push into red-green, I'm willing to go huge. I filled most of my 5,000 show order at 666, but right now I'm sitting back and waiting for the rest of it. I just have 800 shares left open. Again, I don't really care if I'm early with this starter. It's small size, it's more of a just-in-case position at this point. So far, the BCLI perk hasn't been very strong. It hasn't been able to get back through 60 and hold 60. Only a couple minutes to go in pre-market. So maybe market open, I'll fill the rest. Maybe I'll get higher to put my ads on. I really am just sort of sitting back right now and waiting to see what's going to happen. I just filled the rest of my order. We are starting to strengthen a little bit now. Minute and a half to go till open. Had a little bit of a push into the 670s. So far not holding though, got smacked right back under. So while it was a bit of a perk up and I did fill the rest of my order, it wasn't enough of a perk for me to add shares. 5,000 shares is great for a starter here, but if I'm going to really size up, I am waiting for higher. I'm going to be very patient. Market opens up, and I'm hoping for a spike. We have a little bit of a push into the high 660s, but this isn't strong at all, and now we get a snap right out of the gate. BCLI gets very weak. Starts to fade back off towards those pre-market lows. So while it's disappointing that I only have 5,000 shares right now, I'm not going to rush and add. This is what the starter was for, just in case it did wash out of the open and die. I have a 637 cover order in for it right now just because that is about 30 cents a share. It'd be some nice quick gains. But I canceled the order because this is unable to bounce. I've been watching it hold the 640 area and try to perk up, but so far BCLI is just not getting any kind of a spike going. So I don't feel like I need to lock in those profits anymore. It's a good thing I don't because we start to crack even further. We're now down to almost that 630 mark. There's a big bid protecting 630, and once that's taken out, this really could go downhill quickly. Since I am only small size, what's my rush to get out? I can sit back, I can be patient with this, and if it does squeeze higher, I can either take off into the first pullback, or I can just average on up like I originally planned. 630 gets smoked though, now we're down into the 620s. Panic is really starting to set in on BCLI now. Low sixes. So I took off half of my shares at 605, just above the round number of 6, in case that acts as a support. My first piece I paid myself 60 cents a share on. This is a decent bounce off of the 603 low a day, so I covered up the rest. I covered up the rest into that next dip at 605, and it was a bit early. But that was a great gain for 7 minutes into the day. I underestimated the panic. I thought 6 might put up a little bit more of a fight. But I'll happily take my gains on my small position. A quick 10% gainer on a nice gap down play. If you take a look at the end of day chart, you can see that BCLI, it got as low as 560. So I missed the bottom by about 45 cents. However, after that 560 bottom, there was a nice bounce up to 620. I believe I did try playing bounces into the 620 area at one point, but I didn't do too good of a job with it. I got kind of ground out. I probably only made a few cents a share there. By the end of the day, it was weak again though. It turned out to be one of those all-day faders. I may have only had 5,000 shares, but that was planned. It was because the gap down was so large, and I couldn't get close enough to my risk level to really size up. But a small starter position still can go a long way on these ones that fade off hard. This next example, GENE, had a massive run the previous day. It ran from the mid ones all the way up to a high of 468 before closing in the 360s. This morning, with a couple minutes to go until market open, it's opening right around 3. So it is down 20% from the previous close. It's really gapping down large. Since it is such a large gap down, I'm reluctant to start in right away on it. My goal is to build in short into a morning spike towards that red-green mark, that 360 mark. So I'm hoping we do get that morning spike. Yes, it is still up a lot at these levels, but I need it closer to my risk level if I'm going to play it big. The first push out of the gate so far has gotten us as high as 307, and now it's breaking to some new highs. So this is a nice start. This is giving me that push up towards that previous close like I want. And I have a 10,000 share order in at 314 waiting for GENE. I'm hoping we get another push up into the mid-teens here and I can get my starter short. With my risk level up in the 360 area, this starter might be a little bit too big though. On just the starter here, the 10,000 shares, if I were to have to stop out in the 360s, I'd be looking at losing $4,500 to $5,000. That's a little bit bigger than I'd like to take for a loss, especially for what's supposed to just be a starter position. I've filled half of it so far. I have 5,200 shares from my 314 average. It does look like GENE is starting to weaken a little bit, but we haven't gotten total breakdown yet. It snapped under 3, but it couldn't snap low of day at 291. The rest of my order was sitting open at 314, and now most of it is filled. There goes the rest, and I'm up to 10,000 shares from a 314 average, as GENE continues to spike. It's now gotten to a high of 328. So I'm letting GENE ramp here. I'm letting it run. The closer to 360 it gets, the better. The closer it gets, the more and more conviction I'll feel towards having a nice large short on it. I put another 10,000 shares on, though, at 326. So now I have a 320 average. I have 20,000 shares. And GENE, it continues to push, now as high as 336. So my risk is getting a little bit out of control here because now to cut in the 360 area means an $8,000 loss. I do have a lot of conviction in this play. I do think that 360 will reject. I do think it will fade off. But I'm putting myself in a spot where I may not want to cut a loss if it does break through. I'd be reluctant to because of the size I'm playing. Since I've seen some struggles here in the 330s, I have another order sitting at 329. I'm working under the assumption that it's not going to make it to 360. But I don't really have a risk in mind that's lower. So it's kind of a dangerous game I'm playing here. I did cancel the rest of my order that was open though, so I have 23,500 shares from a 321 average. I'm a little bit underwater so far, but I'm semi-comfortable. But here comes yet another perk on GENE. Higher it goes. Now up into the 340s. So this is a picture-perfect spike. But I'm in the spot right now where I have to be a little bit tentative with my ads because I started in so big so early. Really, this is the ideal spot I want to be shorting, but I can't bring myself to do it. I'm only putting on yet another small ad to get up to 30,000 shares on GENE from a 326 average. But really, this is where I should be sizing up, but I can't get myself to because I'm a little bit uneasy with the size that I already have. Still in the 340s, continuing to push to new highs. Getting closer and closer to that red-green mark. I'm still in the position to add more to my GENE position if I want to, but I'm going to really wait on it at this point. I'm going to make it get to that 360 mark. I'm going to short it right at the resistance if I put any more ads on since I was early. This is a hard crack now off of the 350 area though, so this might be the sign that the top is in. We have a big offer at 333 as well. Over 200,000 shares showing. So this big knockback is bailing me out a bit. Big offer at 333 gets chewed through. We've rebounded a little bit off of the 330 area. But this rebound hasn't been very strong so far. Gets back up into the high 330s, but big offers keep coming in at the 335 mark, and finally we snap and have yet another leg down. So it looks like I'm stuck with my 30,000 shares from 326. I'm not going to get any ads. I'm not going to get my average up. But I am back to about break even now on the position. With this crack, I'm now up quite nicely. GENE, it looks like it's finally run out of steam and reality is setting in. Despite being early on my short, I'm not taking any off here though. Usually I'm pretty good about paying myself along the way into dips, but for GENE, I'm getting a bit greedy. I'm trying to really hold out here. Finally, I start paying myself a little bit. I have an order at 304 for a fifth of my shares. But I was a little late getting it in. Now it starts to fill, and there we go. I got a partial fill at 304. And I put in another order at 297. Move it up a penny to 298 because the 297 missed. We had the brief crack under 3, but I couldn't quite get filled. So despite this having faded 50 cents a share off of the highs so far, I've only taken off about a sixth of my position. I still have 25,000 shares. Down here, I really should be covering more because we're right near the lows of the day. And there's a great chance that lows of the day support for a while. Now GENE starts to bounce off a 3 though. It defended for a while and now it has a very nice perk up. This is where emotions come into play a bit. Because now I'm sitting there saying to myself, what on earth is wrong with me? Why didn't I take any off into that dip? I'm watching GENE climb back towards my average, and I'm thinking, wow, I might have just left a lot of profits on the table. After testing the 320 area for a while, GENE does reject. We've been knocked back now into the low 3s. Still being a little too patient here though. I'm not paying myself along the way. I'm not downsizing into dips. Another test in the 305 area and another defense. But there's some more snap under 3. Once again, the low of day area defends though. I know it might sound like I'm speaking with hindsight when I'm saying I should be covering some up here, but that's not hindsight, that's my strategy. This is what I'm usually doing. I'm usually scaling out along the way, settling for the fact that I'm not going to catch dead bottom on all of my shares, and I'll end up with a pretty decent gain to show for it because I pay myself into weakness. But every now and then I fall into this habit like I'm doing with GENE right now, where I get a bit greedy, where I'm thinking about a home run trade, where I want to cover it all dead bottom. And because I'm waiting and hoping that GENE is going to snap low a day, I'm putting myself in the spot where I might have to cover higher later if it does save itself yet again and rip back. This is yet another strong perk off of the 3 area. And another slam back down into the low 3s. It's just choppy and kind of in a channel right now between the 290 area and the 320 area. At this point, I know I'm going to cover my GENE if 320 breaks to the upside, because then I could very easily see this having a nice rip back towards the highs of the day, and then I'd be very nervous. So if 320 breaks, I'd be getting out the rest, and I'd be looking to reshort higher. Had a bit of a perk there, so I took off another 10,000 of my shares. I believe I was out at 316 or 317. That happened pretty quickly. So now I'm locking in a little bit and being cautious in the 3 teens, towards the upper end of a channel, which is really one of the worst places to cover up a stock into strength. Now that 320 resistance level does break though, so I'm taking off the rest into strength. I covered the rest at 324, left a lot on the table there. Taking a look at the intraday chart, that perk up I covered into really was one of the last gasps for GENE on this day. Perked up into the 30s, stuffed yet again, and then faded off the rest of the day. It got as low as the 260s. This was just a very poorly managed trade on both ends. I scaled myself in too aggressively, too far away from my risk level when I was entering, and then I tried to make up for my bad average by getting way over patient with my shares, getting greedy, and trying to hit the home run and cover it all up in the mid to low twos. Instead, because I was uncomfortable, because I was trading poorly, I covered it all up into a perk instead, because the resistance level that really wasn't all that important in the huge scheme of things wound up breaking. So if you watch this GENE action again later, it is a great example of gap down action and a push into the previous closing price. My trading of it was just way off. Next up is NYMX. NYMX is a beautiful overextended chart, previous close at 173, and this morning it is gapping down after a few straight up days. The gap down so far is very small, so I'm actually looking to start in pre-market here at 165. I have a 10,000 share order in with hidden size, and I'm going to fill what I can pre-market. 165 is only 8 cents a share off of the previous close, so that's just a 5% risk on my starter. After multiple up days, I think there's great odds that this gap down is going to be the snap of momentum that brings NYMX lower and back to reality. I've filled my 10,000 shares at 165, and with just a minute to go till the open, I'm adding at 167. I've worked my way up to about 20,000 shares now. I'm adding because it's very obvious this will be a gap down. So I am trusting that that flush is going to follow, that NYMX will slowly fall apart throughout the day. I have another add-in right at market open at 168. I got another 6,000 shares added just about, so I'm 25,900 shares from a 166.6 average right now. NYMX, it does start to pull. So far we've had a quick washout to 160. So far so good. And after this hard pull out of the gate, I could even think about adding the next rebound as well. Of course, in this situation, my risk is around that red-green area. So I'm very happy with where I'm at right now. We are getting a little bit of a bounce off of that 160 area right now, but there's no temptation for me to cover up into the bounce. I don't need to cover into strength here. I'm just sitting back and giving it time to break down further, which it starts to now. Under 160 and down into the 150s. So I'm going to watch NYMX fade off this morning until I see something that I think might be a trend change, and then I'll start thinking about covering up into some dips. If this washout gets severe enough, I probably will start paying myself a little bit along the way also. I'm just looking to take some quick, predictable profits. Despite the 160 crack, it didn't wash out all that hard. Just a few more cents a share. Current low is 157. So the volatility is nothing all that special so far this morning. $160 briefly reclaims and then gets smacked right back under. So this is the kind of slow choppiness that I do need to be patient through. There's been no real sign of strength to make me think that my position's in any kind of danger. And it really hasn't faded all that much yet. We have perked back through 160, and now the 160 perk is strengthening. Up to about 165 now. Again, I'm not covering into random strength here, though. Since that was a strong perk off of the lows, I might take a little off into the next dip. But I'm not going to chase a spike to get out, especially when no key resistance level is broken. A little bit stronger here on the perk up. We're now 167. But we have that 170 high of day and that 173 previous close to play off of. Pretty wide spread on NYMX right now. For a minute there we were 163 by 167. And here we go again. The liquidity really just is nothing special right now. I prefer plays that are trading a little more actively than this. So far the 167 area is rejecting though. And now we're right back down into the low 160s. There's our 160 crack on NYMX. So here comes a potential low a day test. Maybe once we get through this low a day after that failed bounce into the mid 160s, it finally starts to speed up to the downside a little bit. Now we're at new lows. Had some 156 prints there. Big bidder at 156 gets chewed through. But that level never does quite lift. Here comes another attempt with a big offer sitting at 157, trying to push it down. It moves down to 154 and partially fills, and we get some more crack. But pretty quickly it got taken out right there. So now the big offer is gone. But so far, NYMX isn't really perking up all that much. It's staying under 160. We perk up a couple more cents, and now we're testing that 160 mark. Even breaking through, getting up to 161. And now start to strengthen even more. So I'm not liking this rebound. This is a very strong rebound for NYMX after that low a day crack. However, it is still under that previous rebound of 167. It's under the morning high of 170. And of course, it's under red-green 173. So I'm not going to let myself emotionally cover out of fear into that perk. What I will do, though, is start thinking about downsizing into dips. NYMX is back into the 150s now. But I do start to take some off at 160 because I'm starting to wonder if this is going to set a higher low and then start to ramp back up and rip on me. I know it doesn't happen often, but I need to protect myself just in case it does. And since that last perk was up to 164, I consider this 160 cover to be into enough of a dip. My order filled, and I'm now down to 20,000 shares. NYMX continues hanging on in the high 150s. I still have most of my size because, like I said, there's a ton of resistance levels overhead. I don't need to cover up all my shares right here just because it's dipped a few cents a share off the last perk. I want to give this a little time to try to break down further. But the longer it holds this high 150s, low 160s area, the more and more I'm going to think I probably should get out some. And here's yet another perk up. So this choppiness definitely has me a bit uncomfortable right now. Low 160s, still just going sideways. There's a big offer at 161, so it'd be pretty easy to downsize into that if we don't start to break down soon. But there's a little bit of pull here. We're back under 160. Some size showing on the offer once again. So if I decide I don't like the action that I'm seeing, I can just smack the ask and then get downsized a bit. It's always good to know that size is there to fill into. I did downsize another 5,000 shares there at 160. And I take advantage of the offer at 161 to take off the rest of my shares. So now I'm flat. I got scared out into the consolidation during the first red day. My covers were ultra conservative, but I still walked away with a decent gain. Taking a look at the end of day chart, NYMX did perk up again a bit after my covers. It had a perk back into the high 160s before failing and eventually fading back off. It closed at its lows of the day, down in the high 130s. Given how much this was up and the fact that this was the first red day, this really wasn't that huge of a surprise. I just lost sight of the big picture. My entries in the morning were fantastic, but my covers were super conservative. I was thinking about taking off a piece to protect myself in case it came back up a bit. Instead, I wound up covering everything. In the moment, I got scared out by the grind. I forgot how high odds these gap down setups are, especially after large overextension, and I really wound up minimizing my profits on this ticker. But the glass half full way to look at this is that even though I screwed up, I still came out with gains, and those are the best kinds of setups to be trading. The ones where you can make mistakes but still profit. Next up, we'll get a look at RADA. RADA is a chart that has a couple things going on right now. It had a huge run yesterday from the mid 2s up into the high 3s, and now this morning it's gapping down quite large. So that's a great gap down setup. The other thing RADA had going for it though was the $4 multi-day resistance level overhead. So when you combine those two factors, it seems very likely that RADA is going to head lower this morning. So I just have to hope for a pop back towards the red-green mark of 369 now that the market is opened so that I can get short a little bit closer to my risk level. So far, RADA is opening a bit weak, but now it starts to perk up. It's through 350 and pushing up towards 360. So the closer this gets to the previous close of 369, the better. Even though there's that $4 daily resistance level overhead, I still would want to risk off of the red-green area in this situation. Pushing well into the 360s now. At this point, I still haven't quite started in though. I'm being cautious and making sure it's not going to just blow straight through. Right there, I take my starter though at 362. I now have 10,000 shares and RADA has snapped right back under the 360 mark. Now that RADA has had its first pull, I would be comfortable adding some more into pops, risking off of that 369 previous close area. I feel much more confident now that it has rejected the first time. So far it's just grinding in the low 350s though. We have a quick 350 snap and we even just touched the 330s briefly. So very fast downside for RADA there. It looks like I'm not going to get that bounce to add into. And RADA just keeps on fading. Right back down near the lows of the day. I actually just took advantage of that large pullback to pay myself on half of my shares. Sometimes it's very hard for me not to take off when I see a huge downward move like that. I have lost a little bit of sight of the big picture though on how much RADA is still up compared to the previous day. We continue to fade off a little more though. We've tested the mid 330s. And now a slight perk back into the 340s area. For whatever reason, I decide I want to be done. I take off my last 5,000 shares down here at 342. Actually, I get executed all except for 300 shares. So a bit quick to pay myself on this one. We are only 9 minutes into the day, and RADA still does have a lot of room it could come down, given how much it ran the previous day from the mid-2s. I'm leaving my last 300 shares in there. I want them to execute into a pullback. So far the RADA bounce, it did get up almost into the 350 area. And there is a big bid propping it now also at 346. Looks like they just pulled it though. But with 300 shares, I don't need to chase into strength. I don't need to freak out and get out at any cost. I can be patient. Right there, I get my fill. I'm flat for a quick 20 cents a share, just about a 6% gain. So a quick, easy move on the morning gap down setup, paying myself into the dip. And now as the day goes on, I can look for bounces for a reshort. Taking a look at the end-of-day chart, RADA, it did eventually have a pretty nice squeeze back up. It actually squeezed green briefly. Got as high as 380. Unfortunately, I never reshorted this move, and then it faded off all day back into the high 2s. It closed at 294, got as low as 288. Normally that squeeze through green might be a long trigger for me because it's getting through red-green and it's also getting through the previous day's high given where it closed. But because of that $4 overhead resistance area, this turned into a short into resistance opportunity. I just happened to miss it. But you could have easily shorted into that move up towards 380, risking off of the 4 area. I wound up just taking my morning piece on RADA and then moving on to other plays. Did I leave a lot on the table? Absolutely. But another great example of how even if you mess it up, there is great profit opportunity there. One last example we'll take a look at is ANV. ANV has run 3 days in a row from the low $1 area up to 204 without going red. While I don't have pre-market action up on the intraday chart right now, if you look over at the level 2 box, you can see that ANV, it is gapping down so far. With under 10 minutes to go until market open, ANV is 190 by 191. So a fairly significant gap down, about 5%. It looks like this will probably open up red, and that red open, I believe, will bring it lower. It's that perfect combination of an overextended daily chart that is going red for the first time. There's a big bid in right now at 190. Really, that's probably the only reason that ANV isn't gapping down more so far. I feel like this big bid is probably propping it up. Since it has had 3 straight up days, this is an area where I want to start in short pre-market. So I did actually hit a little bit of that large bid. I took 10,000 shares at 190 as my starter short. I'm only risking 15 cents a share about off of the previous closing price, so I'm very comfortable with that. That's a very under control risk for me. Should this open up and have a spike back towards red-green, back towards that $2 area, I can just go ahead and add. I won't fight it if it gets green, but I certainly would be willing to add pops in this situation. Thinking about it on the daily chart, it's up multiple days in a row. It's up a large percentage. So now that it's gapping down, I am super comfortable. I do not mind this starter at all. Market is about to open. We're 190 by 195. Few hits coming on an ANV. So far, volume is nothing special. So far, a little bit of a perk up from 190 to the 193 area. But this really isn't all that volatile. This isn't all that liquid at the moment. I'm okay just sitting and watching. And there we get a snap and some real volume starts to come in. We're under 190, down to 180. Just like that. I'm up a dime a share. Like the RADA example, I could be paying myself into pulls there. But with ANV, I'm being a little bit more patient. I feel very in control on this setup. A little bit of a bounce off of 180 up into the mid 180s now. But not very strong at the moment. If I'm going to add into a bounce, I need it to be a better bounce than this. Now we're talking. Started to speed up a little bit to the upside. Bounce got into the high 180s for a second there, before fading right back to the mid 180s. I decided to put on 5,000 more shares at 185. Because I'm thinking that maybe this 190 area is going to hold. That wasn't a very strong perk through 185 earlier, and it got stuffed very quickly. So far I've filled most of my ad. I have 14,100 shares. Just 900 left to fill. Just filled the rest, and now I have my 15,000 from a 188.33 average. $15,000 shares, it's not that big of a position size for me. So even though I'm a little bit far off of the previous closing price, I'm still totally okay risking this starter size off of that 204 area. Should we somehow get a large spike up into the 2 area, I'd be absolutely giddy to add size up there. So far, it's looking like that's not totally out of the question. ANV is perking up a little bit more. It just tested and broke through the 190 area, and it has a big bid in there now too at 190. 282,000 shares showing. I am electing to use the wider risk and play off of red-green, but I also could be using the high of day as risk right now if I wanted to. I'm not going to say one way is right or wrong, it's just a matter of preference and how you want to structure your position. That big bid is still sitting in there, but so far it's really failing to produce any kind of a major push. We tested the 192 area, but that's it. The bid is getting chipped away a little bit, but so far not too significantly. Now a bit more. We just got down to under 200,000 shares. So once this is under 190 again, this may slip right back off. I'm not adding here just because I do want to keep my risk under control. I don't want to have too much size, 15 cents a share off of the previous closing price. So I'll save any ads for higher in the $2 area. No need to here though. $190 is still propping, but we have lost almost half of that large bid now. I'll be very curious to see how this reacts once it snaps. There it goes. The big bid is gone. We're under 190 again. The 190 crack, it hasn't brought on panic though. High 180s are still holding. So this may just slowly fade off, and the longer this consolidates up here, the more and more I may think about putting my risk off of that 193 area instead. Just because why fight a position when you could just cut it for a couple cents a share loss and restart higher? For now, no significant perk though. It's just slowly fading away. Had a 186 hit there for a second. Another one of those situations where it's kind of slow, kind of illiquid. It does take a bit of patience to stay comfortable. But now we're in the mid 180s. 185 is getting tested. We briefly touched 183 there, but there was another big bid at 183. It was for 100,000 shares. Next time it knocks back down there, we'll see if it's still there. Yep, there it is. But we also have a somewhat sizable offer now. Just saw one at 185 for 40,000 shares. So I'm trying not to let this slow fade make me impatient. These are those situations where you're going to want to probably cover up if you get bored. Usually that's what happens to me. But I'm really trying to just sit back and wait and make this either change trend or crack lower, and then I can cover up into more fade. We lose half of the 183 big bid. So if we get rid of that other 50,000 shares, we may see a low of day test soon. There it goes. It's gone, and we're down at 181. Since low of day is 180, I have a cover order for 5,000 of my shares at 181 here. I fill it, and now I'm down to 2/3 of my original size, and we're at new lows of the day. I covered those shares there just because it was right above a key support level. So why not take some off? Why not reduce my risk? I wanted to make sure I was paying myself into dips in case 180 had held for a while and it had started to grind back. I didn't want to make impatient covers into a perk. Get further crack into the 170s, I have another cover order at 171 that I've filled a good chunk of so far, and now I've covered it all. So 5,000 shares remaining from a 185 average. This fade is starting to work out pretty well for me. This time I'm paying myself into dips. I'm not letting the stock turn around and bounce and make me impatient because of how illiquid it is. I do now have the cover order for the last 5,000 of my shares in at 173. Because 171 held the first time, this is a pretty strong bounce off of the 171 area, or at least a bit stronger than we've seen in a while from ANV. So I'm hoping we get some dip back down into the low 170s and I can take off and do a higher low. Instead, we're up in the high 170s so far. At this point, it looks like I've missed my cover on that last third. But yet another example where I can sit back, I can be patient. I don't need to chase this spike. I don't need to get out this last 5,000 shares at any cost. I can let the stock dip and come back to me. Overall, this is still a very bearish trend. These listed stocks, they will be choppy on the way down, and I know it. $180 briefly tested for ANV, but it rejected. Now we're fading back off into the mid 170s. At this point, just a couple cents away from the last of my cover order. $173 bid starts getting tested. I filled my first 1,000 shares, now another 1,000. Right there, I get flat. So I'm out ANV for about a 7% gain, and I'm ready to move on to the next setup. Checking out the end-of-day chart on ANV, there was further fade. It did close at the lows of the day. I got down as low as 149, closing at 150. So the common theme I'm starting to see through some of these gap down plays of mine is that I really could stand to be a bit more patient. I know that is not a strength of mine though. I know that sometimes I get shaken out into perks. Sometimes I cover during consolidation periods. So I make sure to pay myself along the way into dips. I know my strengths, I know my weaknesses. And until I work on my weaknesses and improve upon them, I have no business trying to be patient until close. I'll take the part of the move that is comfortable for me time and time again, and maybe at the end of the day, I will cry over leaving money on the table, but I can still be happy with the fact that I made it out with yet another nice, predictable win. Chapter 12 is going to focus around shorting into bounces, building off of some of the ideas we covered in Chapter 11. Shorting into gap downs, or shorting the first time a stock is red when you feel like the momentum is snapped and it's on the backside of the move, that's great. But sometimes you're going to find yourself in a situation where you're unable to get in near the open or unable to get near that red-green mark. Maybe you just don't get your ideal entry and the stock drops without you. Or maybe you get your entry, cover up way too early, and then the stock keeps on declining. That doesn't necessarily mean the play is over. You don't need to delete the chart and move on to something else. These do offer multiple opportunities throughout the day. I really like shorting into bounces on these red days. Because it is the backside of the move, because it's the gap down, the first time the stock has been red in days, but most importantly, because I expect these to be choppy, I'm okay with shorting into strength. I'm okay with shorting into bounces that get near previous resistance levels, areas where bounces maybe 30 minutes ago, an hour ago, or even earlier failed. Those are great areas to either look for an add to a current position or look for a reshort if you've already covered up into the dips. So for the last part of this chapter, that's what we're going to focus on. We're going to go through a few examples where I can show you how I short into bounces. But one thing you will see is that you must respect risk. Like any other setup, sometimes these can do the unexpected. Sometimes they can get a bit crazy. So like everything else, you need to respect that risk level. You cannot let yourself get too biased, because if you do, you open the door to a large loss. Let's start by taking a look at a few examples from earlier in this chapter. Take a look at FRO. FRO did have a decent gap down from the 462 area down to 450. Maybe you missed that for some reason, and then it flushed all the way down to the low fours. Well, between 10:30 and 11 o'clock, FRO had an awesome bounce. It bounced from those low fours all the way back up into the 440s. That is a very easy area to take a short into a bounce and risk either off of the high of the day at that point, which is just over 450, or previous close still. You could still use 462 in this situation. You can get in and size in appropriately with a predefined risk, and then either the stock goes in your favor and continues dropping, which most times it will, or it doesn't, and you have to cut a loss, which should be a very controllable loss given the risk you built into. IBIO is another great example. IBIO gapped down almost 10%. Let's say you missed the first drop. Let's say you even missed that first bounce back up into the 210 or 215 area. And then you watch IBIO drop again into the mid ones and you feel like you've missed the play. Yeah, that's a terrible feeling, but don't give up. IBIO, it did ramp back over the next couple of hours. It got back near $2. In this case, I would most likely use that first bounce high as my risk, that bounce that went up into the 210 area. If I have to stop out at 210, I'm losing maybe a dime a share, maybe 15 cents. But if IBIO fades off for the rest of the day like some of these gap downs tend to do, what's the reward there? That faded off 70 cents from the $2 area into the close. But one example here to talk about how you need to respect your risk is LAKE. LAKE happened very, very fast on the morning of its big drop. Tanked from 28 down to 23. It's very possible that you missed that first move. And then the bounce from 23 up to 25, maybe you say you don't want that. Maybe you wanted a bigger bounce to short into, so you miss. All of a sudden, the stock's down at 21 later. You feel like you've missed out. This stinks. LAKE, it tanked without you. But then it starts to squeeze back. You get to squeeze all the way back into the $25 area, and you can short risking off of that area. But if you get stubborn, if you hold, hoping for the best, when that 25 area breaks later, suddenly you're squeezed back. It gets through green. It got towards 30 this day. You have to be cautious shorting these bounces. Yes, after that big squeeze through 30, it faded all the way back down to 21. But do you really want to put yourself in that situation where you're fighting the stock down $5 a share? No, it's much easier to reshort higher once you feel like maybe momentum is fizzled. Just because LAKE worked out, just because it faded off again towards the end of the day, that doesn't mean they all will. Remember chapter 9, when I talked about NDRM, when I talked about PBMD. What's going to happen if it's that 1 out of 100 and it just keeps on spiking and spiking and spiking once it gets through green and you've gotten stubborn with a bounce play? That's how accounts blow up. So shorting into bounces, it is a great risk reward, but only if you respect your risk. Let's get a look at a couple live examples now of when I tried shorting this setup. Let's start off here with ANV. ANV was the last live trade example you saw where I was shorting after the gap down. My covers were a bit early though, it dropped all the way down to 158. But now ANV, it's in the midst of a really nice bounce. It's bouncing back up into a previous resistance area, that area where the 180 bounce earlier failed. It's been chopping around up near 180 for quite a while now, failing to break through, so I'm starting into a short. I've already taken 5,000 shares at 177, and I have another 5,000 shares in at 178 to add. I'm risking off of this 180 area that's rejected so many times. If I'm wrong, I'm going to lose just a few cents a share. If I'm right, this could potentially fade back to low of days or lower. My 178 order is on the best offer right now. I'm just sitting back and waiting and hoping that it gets executed. If you're wondering why I don't just hit the bid at 177, it's because short sell restriction is on. This has dropped more than 10% from the previous close, so I can't hit into weakness. I can only short into an uptick. That is why my order must wait on the offer. Unfortunately, we drop a little bit. We're down into the mid 170s now. I currently only have 5,000 shares, and now it's the low 170s. I'm going to need a perk back up, or I'm not going to fill. I'm going to have to settle for 5,000 shares. In fact, I go ahead and I cancel my order at 178. At this point, I don't expect I'm going to get that fill. I've moved the order down now. I've put it at 176. I have it at 176 just because I don't think it gets back up to 178, so I'm willing to settle for a couple cents a share lower. Considering my risk is only off of the 180 area, it's really not that big of a deal. I've filled and now I'm 10,000 shares from 176.5. So this is where I have to force patience on my part. I'm either going to cut it if it breaks past 180, or into a nice fade I'll take profits. I do not want to cover at 177, 178, 179 out of boredom before that key resistance level is broken. Otherwise, I'm just covering at the top end of a channel. Another hard drop here for ANV though, back to the low 170s. So it's definitely looking like this is weakening a bit. But a crack under the 170 area, that would be great. 170 briefly got tested there. But there's the snap. We had 168 prints, but then it perked right back over 170. So this is just that slow choppiness we talk about. Right now, ANV is just going over and under 170. The longer the high 160s hold, the more and more I may think about taking off a piece into that low 170s or high 160s area. Because in this case, at least it would be towards the low end of a channel. It'd be into some small fade, not into a perk, just a couple cents a share off of the key resistance I'm trying to play off of. But despite all these high 160s holds, we haven't been able to perk above the low 170s. Since we are just slowly grinding, let's go ahead and speed the action up just a little bit more, so we don't have to watch too much consolidation. At this point, I really am just waiting to see which way the stock breaks out of this slow sideways grind. But because of the daily chart, I believe that the big picture is on my side. I believe that the odds are on my side that this fades off more. ANV is starting to perk a little bit here. but to this point it hasn't been too meaningful. Got to 173, but that was it. And now right back under 170. We're back to testing the high 160s. So far they're defending well. These are the grinds that are just excruciating to hold through. It's so easy to get bored. I'm bored watching this at sped up speed. Just imagine real time. Finally, we start to see some snap though. We're testing the mid 160s. I preemptively put a cover order in at 163. I've filled half of my shares into this dip because it is getting close to the low of the day. Current low is 158, so I do want to cover just above support. I've taken half and now I can give the other half a little bit more time to work. Maybe I can cover it at new lows. Strong bounce back off of the low 160s. Testing 169 and now 170 again. Even briefly breaking through 170. So that was quite the bounce back. The 170s did reject once again though. We're back to churning in the high 160s. I throw in a cover order for the remainder of my shares. An order that I really don't love because even though this did just fade a little bit off of 170, it is still chasing a perk in my mind. It's had so much trouble in the low 170s, so why am I covering only 5 cents a share below that level? I do get filled though. I've tacked on an additional $1,100 to my day's profits. That trade right there was another easy 5 or 6% gain. Checking the end-of-day chart now, not much to say here because we did already talk about it in the last trade example. It did close lower once again, closed at 150, it was as low as 149. Bit of a missed opportunity on my part holding that last piece. I really was impatient to cover it into that perk there at the end. But my entries were spot on, and even though my covers weren't perfect, I still caught the meat of the move. I still got out with a nice gain. Finally, we'll take a look at ARNA. I had quite a bit of luck shorting ARNA into the gap down this morning. I got short into the spike towards 573, and by now I've covered up and I've already locked in a little over $6,000 on the day. I had a great first trade on it. ARNA did get as low as 510 though, and now it is having its bounce. So I want to short into this bounce, and you may see that I'm already putting in orders to short into this bounce at 536 and 537, and I want my risk level to be in the mid 540s where this previous spike failed. So right now I'm going in with about 10 cents a share of risk, at least 25 cents a share of downside if it can retest the lows, maybe even more if it can crack further. I've now filled my 10,000 shares. I have a 536.5 average. So now it's just a matter of watching ARNA and seeing if we can get that fade back off. I also wouldn't rule out adding more if it pushes a little bit closer to that risk level up in the 545 area. Again, I'm interested in 545 because earlier that is where the first bounce failed. So now that we're bouncing from even lower from 510, I expect that level to hold. ARNA gets a bit weak here. We're down into the low 530s, so already starting to pull back a little bit. About 540 is where that rebound just topped out. Now we're under 530. So it looked like my entry was pretty close to the top here of the bounce. If this consolidates for a while, I could consider moving my risk down to 540, but I do think that 545 level is a little more important from that first bounce. I'm just sitting back totally comfortable in ARNA right now. I know my risk. It's not at all an out of control risk for me. I have 10,000 shares. I'm risking 10 cents a share, so that's just $1,000. Wouldn't kill my day or anything if I had to cut it. So far, we've gotten some decent fade, and I do anticipate this heading lower. So this is a spot where I'm just going to sit back and let the chart play out. If I'm right, great. I'll pay myself along the way, and if I'm wrong, I'll just have to cut it when it breaks 545. We're continuing to fade here, testing the 527 area. Certainly looking like ARNA is on its way back down. Now to 526. Now low 520s. So when it comes to covering this up and taking my profits, I really could do one of two things. Right here, you'll see I threw in half my shares at 521 because we are getting kind of close to that low of day support. So my goal is to pay myself a little bit here. I'm already up 15 cents a share. But I canceled the order because it did hold 520. It's starting to bounce a little bit now. I'm not totally sure if I'm going to get that fill at 521, so I just pulled it. That also wasn't the strongest bounce in the world off of 520. So I'm thinking maybe it can snap and head even lower for me. You start to see a bit of a perk up now that we're back into the 530s. I'm not thrilled to see it coming back, but it's also not super alarming. 530 isn't exactly a key level. So I feel no need to chase this perk up. But since it is kind of a strong perk, I may want to consider covering a little bit into the next dip. After all, I did fail to pay myself in that 521 area. I didn't get executed, and then I didn't pay a couple cents more per share to get out. The ARNA bounce continues to strengthen. Now to the mid 530s again. So it is approaching where it topped out previously at 540. But of course the 545 area is still where I have my focus. Now high 530s. So this is a bit of unexpected strength out of ARNA. Suddenly it's through 540. So it may retest that 545 area. Now we've perked through 545, the area I wanted to risk off of. I'm still in my shares, and I'm thinking that I just want to get covered up into a quick pull. I'm no longer comfortable in this trade. I'm down a dime a share. I'm also quite agitated that I didn't take any off into the first fade down into the low 520s. I briefly had a short ad order in there because I thought the 545 area was rejecting. I canceled the order luckily, but now we're perking up even further to 550. I haven't cut my loss like I planned on. I'm getting a little stubborn and frustrated. I actually have an ad here at 555 because now I'm looking to the next resistance area. There was a very brief perk just after 930 up in this 555 area. So I'm hoping that this will act as resistance now. Short sell restriction is making my fills tough, but I do get my ads. Now I have 20,000 shares from 546. What I'm doing here is I'm falling into the mental trap of getting stubborn, being frustrated, and moving my risk up as I go. I'm not sticking to my original plan. Now I want to play off the next higher resistance level. So far, so good. It is holding. But this is a risky game I'm playing here. My original entry, I didn't plan for this. But now I'm choosing to fight the stock. I'm thinking to myself that this was just at 520, and this should get tired soon. We have held under 560 for a while here, though. Slow and sideways, but now a perk right back up, and we blow through 560. Once again, I don't cut. I still have my shares. Now I'm thinking about the high of day, 573. Thinking, well, maybe that's the resistance it will hold now. But nope, right through 573. We hit 575 briefly. Now through 575. So now I'm thinking about 585, the previous close. This can't possibly squeeze back all the way green. I just keep moving my risk level up and up and up and up. I keep saying, well, the resistance I wanted to play off of didn't hold, so maybe the next one will. And then when that fails, I say, well, maybe the next one will. It did fail to get green, 584 rejected. We've pulled back to the 570s. But I'm still underwater by 25 cents a share. Now a bit harder of a crack to the low 560s, so this is starting to look a little bit better. I'm saying to myself, okay, I guess I was smart to risk off of green. Despite that dip, though, I don't downsize. I don't take any of my shares off. We perk right back into the 570s. I'm back into that all too familiar stubborn hold, where I'm just waiting and hoping for break even. This rebound is a little bit concerning to me, but I'm hoping it's just going to turn out to be a lower high. Low 570s are testing right now, trying to get back into the 560s, but supporting surprisingly well. Now a strong perk into the 580s. Arna is now green on the day. I'm still holding my 20,000 shares from 546. I'm down almost 50 cents a share. Now I am down 50 cents a share, so 5 figures on this trade, on something that originally was a $1,000 risk. Now, of course, I'm thinking about the next resistance level, the previous day's high, which is right around 610. As this trade developed, I just kept moving the risk level up one at a time, because I was too stubborn to cut a loss. There's our 610 test, and now 615. Quickly a spike up to 620. So ARNA is now higher than it was yesterday. I am massively twisted on this position. Now 20,000 shares, that's not huge for me. I could add to this position still. But I'm very emotionally flustered at this point, and I don't really know where to add. I'm out of resistance levels to play off of. So because I'm already down 5 figures on this trade, I have to be very careful. I don't want to just keep adding. While I didn't respect risk levels and I kept moving them up, at least I wasn't averaging up with each one as well. That is the one thing I did well. I only put on the one ad. But that is about it. New highs for ARNA, just tested 625. That wasn't a very strong break though, and now pulling into the low sixes. I definitely recall thinking that the squeeze was about out of juice up here and thinking about ads. Because this was kind of a hard crack off the 625 area and the 6 retest. So if there were anywhere I was going to add, it would be here into pops with 625 risk. But can I really trust myself to stick to that risk? The way things have gone so far? ARNA continues to trade choppy in the low sixes. I just have my fingers crossed hoping for that snap. I've put myself in a hold and hope situation. I am very nervous about this setup at this point because, like I said, this is at new highs. It's gotten higher than it did yesterday. So that 625 level, that's very important to me right now. And I know this is practically the front side of a move at this point. We're back to this stock being strong and squeezing, and I have no idea how high it could possibly go given the volume that it's trading. So in my mind right now, 625, it is where I have to cut, whether I add or not. I can't risk this going to 7 on me or going to 8 and getting really out of hand. We're back in the low sixes though, but the low sixes are defending very well. This is basically a channel right now between $6 and $6.25. I briefly have ads in here at 610 and 609 because I think the pops are getting weaker. I even move one down to 608. It is quite a bit of size I think about adding. I watched $6 hold again on another test though, so I cancel my ad orders. I can't ignore the fact that this just keeps supporting time and time again. I don't want to add crazy size up here and get my risk way out of control. The ARNA perk starts to strengthen. Now up to the 620s. It looks like it might bust through that 625 mark. There it goes. It blew right through and I had to cut my loss, and I go from up $6,000 on the day to down almost $10,000. Unfortunately, where I cut the loss, I probably cut it dead top at 628. It was a little fake breakout through 625, and then we got the crack and fade off. Now the problem is it only faded to 575, so even if I had held my shares there, I wouldn't have gotten out for break even. It would have been less damage, sure, but holding through that high a day break, it would have been incredibly risky. I had to cut the loss there. I had to protect myself. Unfortunately, it was about 4 risk levels too late. Like I said, I just kept moving the risk level up one at a time as I went. And that was the wrong way to approach this. Instead of saying I can just cover this, take the small loss, and re-attack higher, I got stubborn, I dug in my heels, I decided to fight, and I'm stuck with yet another big loser because of it. To wrap up, let's go through a few of the main things to take away from chapters 11 and 12. First and most importantly, the daily chart must be overextended if you're playing these gap down plays or if you're playing into bounces. That is the main thing I look for, is that daily overextension. The stock needs to have room to come down. Like I mentioned early in the chapter, the reason I like these plays so much when they gap down or the first time they're red is because it is a big momentum snap. The buyers are no longer in control, and in a lot of cases it puts a lot of longs underwater. Always remember that the play is not over if you miss your first entry. You can always find bounces later in the day to short. Finally, no matter which setup you are playing, whether it be the overextended gap down or the bounce, like any other setup, you have to respect your risk. You just saw what happened to me on ARNA when I did not respect my risk. You've seen it happen to me multiple times through this DVD. So never assume what a stock can and cannot do. If your risk level breaks, if the stock does something unexpected, just cut it and live to fight another day. For those of you still watching, let me just say thank you for your dedication and for making it all the way to the end of this DVD. I'd like to wrap up with a few concluding thoughts before I leave you. First of all, and this goes for all traders, whether new or old, always start small when learning a new strategy. If you're trying something new, whether it be something you saw in this DVD or an idea of your own, don't dive in all at once. You don't need to put that kind of risk on the line. When you are learning, when you are practicing, when you're adjusting, that is the time to play small. That is the time to make your mistakes so that your mistakes won't be too expensive. I've said earlier in this DVD that mistakes were my best learning tool. If I had been playing too large, I would have never had the chance to succeed because those mistakes would have wiped me out and I would not have been able to recover. The second point that I want to make sure everybody remembers is that you must cut losses. Over the past couple of years and through this DVD, I'm sure that at least half of the money I've lost has been needlessly lost through holding stubbornly. I'm sure this advice can be a little hard to take from me given that you've seen me fail multiple times at it, but trust me when I say the ones that do work out and come back in your favor, they are just not worth it. Reinforcing the bad habit of holding stubborn just sets you up for that big loser down the road, whether it happens in a month, a year, or 10 years. Eventually that one outlier stock comes along, your luck runs out, and you take a loss beyond what you ever thought possible. Don't let that be how your story ends. Set your pride aside, set your ego aside, be better than me. Eat that loss when your risk level is breached, and live to fight another day. The third thing I want to touch on is to never stop learning. Don't let this DVD be the end of your education journey. Whatever guru services you might be signed up to right now, don't be satisfied with that. Continue to explore new ideas on your own. Always strive to improve. You may be tearing it up in one sector of the market, but what happens if that sector runs dry? Do you have something to fall back on? I consider myself a student for life. I will always be pushing myself to learn that next setup. As I record this right now, I'm in the very beginning stages of trying to understand how to buy some of these runners before they really get spiking and squeezing. I want to put myself on the long side of the trade. It's a setup I currently am not good at, but I'm tracking it, I'm learning it, and I'm playing it small while I try to adjust and get going. Eventually, I hope it becomes another very successful strategy of mine that I can write about. But if not, I'll just move on to something new once again. I will never be satisfied, I will always try to better myself, and I challenge you all to do the same. Finally, and most importantly, be yourself. You learned a lot of setups in this DVD. Maybe some of them really make sense to you, maybe some of them don't. Don't try to mimic me. Don't try to mimic another guru. Don't try to be somebody else and do exactly what they say. Take the journey on your own. Learn from others. Learn where they succeed. Learn what they do to enable themselves to succeed. But your trading style should fit your personality. For some of you, maybe that's the same as me. For others, maybe you're the complete opposite. I hope all of you have learned something from this DVD, but I hope none of you set out to try to trade exactly like I do. That's a journey you need to take for yourself. You need to see where you succeed. You need to see where you fail. You need to be your own trader, become self-sufficient, and craft the strategy that best fits you. I hope you are all able to do that, and I hope one day to be learning your strategies. Thank you all again so much for watching, and best of luck trading.